In London with Tom McKenzie.
And here are your top stories. Cash in or cash out? Carlyle's David Rubenstein says it is time to buy the dip. Bridgewater's Ray Dalio, though, warns of another 20% plunge in equities. Brace for a hard landing. The 2s and 30s Treasury curve hits its most inverted this century as short-end yields jump, but stocks recover after their brutal sell-off. Plus, energy intervention. The EU unveils its crisis plan, but shelves ideas of a price cap. The ECB's Holtzman warns inflation is set to accelerate even more.
If you look at the futures, Tom, they're fluctuating a little bit. So yesterday there were a bit of dip buyers actually later on in the stretch in the U.S. And then it's all about data, once again from the U.S. to give us clues of what the Fed does next. But here in Europe, it's pretty much subdued.
Yeah, producer price inflation out of the U.S. came in a little softer than expected, giving some relief to investors. Part of the mix in terms of the upside that we saw yesterday in terms of the gains on Wall Street. But will they be short-lived? As Francine was saying, of course, you have the University of Michigan survey, sentiment survey out on Friday. Retail sales out of the U.S. as well to round out the picture, to flesh it out in terms of our understanding, give us a better understanding of where the Fed may go. 75 basis points certainly priced in fully now for next week. Gains here in the UK, FTSE 100, just up 0.2%. The CAC current is up as well, or current, I should say, down 0.2%. The FTSE 100 is gaining. The German DAX is essentially range-bound at this point, the Spanish IBEX as well. So looking for traction, it seems, these markets, looking for some kind of catalyst on warnings again from some ECB officials that inflation is going to remain with us for longer. And of course, that debate as to how far the ECB goes as well. We have some lines crossing in terms of the merge with Ethereum. This is something that people in the crypto space have been watching and counting down to for a number of weeks. Expectations from some that it's going to lead to a recovery in the price for Ethereum, though in the last few trading sessions, it has largely been lower. Ethereum's long-awaited energy-saving merge is done. That is the line crossing the terminal, and we will get more details on that throughout the hour. S&P futures currently unchanged, again, after turning to the green in the positive yesterday. The euro below parity at 99 for the cent for the US dollar. The 2-year, again, we talked about that inversion with the 30, the biggest inversion we've seen now this century. 383 on the US 2-year as you start to look maybe at a terminal rate for the Fed of possibly 4.3% next year, possibly higher, 4.5%. Ray Dalio giving his thoughts on what that may mean for the equity markets and maybe a 20% correction. Ether, there we go, checking on the price, currently at 1,600 for Ether, just a gain of 0.2% on the back of the news that the merge now has happened. Francine?
Yeah, I'm excited about the merge. It's one of the biggest, most significant things, of course, when it comes to Bitcoin, or it's certainly stable coins, some people call them, but so many questions about where we go next. This is a picture for some of, the sectors that we're definitely watching. Banks, auto parts, retail, higher than all the other ones, getting between 0.8 and 0.3%. You only have utilities, real estate, healthcare on the downside, but they're not trading lower by that much, Tom. They're about 3% slower.
Okay, as we mentioned, we have been getting some mixed signals then from market giants. Ray Dalio is warning that rates will have to rise to between 4.5% and 6%, which he says would lead to a 20% plunge in stocks. But David Rubenstein thinks it is in fact a good time to buy into this market. Let's bring in then Bloomberg's Christina Kino from our markets team. Christine, just give us your views on what we saw in the markets yesterday. Dip buying, but can it be sustained?
Well, John, that is the big question, isn't it? And I think what we've seen from the history of equity rallies over the last few months, you really can't trust any rally here because the specter of Fed rate hikes and tighter monetary policy is just around the corner. Time and time again, we've seen these rallies kind of come through, only to fade when we get a reminder that policymakers are still very much keen on getting inflation under control, even at the expense of growth. And that's kind of the message that we've been getting from a lot of market watchers, from the Fed itself, that they are very much looking at jumbo rate hikes, more jumbo rate hikes in the coming meeting, potentially even 100 basis points. I mean, that's still very much up for debate, but the fact that it's part of the conversation in and of itself is a signal that markets are very much expecting more pain from this Fed process moving forward.
So, Christina, are there any parts in the markets where actually it looks like a bargain? I don't know whether there's dip buying that we saw yesterday in the U.S., late trading, that will continue.
Well, Francine, I mean, there's definitely some bargains to be had here. But again, the question is, are they cheap for a reason, right? I mean, we have seen valuations plummet for a lot of growth-sensitive stocks. I mean, the tech sector, for instance, has been quite battered really all year as a function of various risks in the market. But then again, the question is there a reason, right? And we have seen the valuations of such sectors over the past few years really kind of skyrocket as a result of the era of easy monetary policy. But now that that's going away, it makes a lot of sense that we are seeing these sectors cheapening. I think moving forward, though, the question is, will they kind of benefit eventually once inflation is under control? And once we get past that kind of growth slowdown or even recession point, it may take some time, though, I think, before all of that kind of flows through to the market.
Christine, on the yield inversion story, 383 on your 2-year, yields up 4 basis points in the session today. The 30-year, 349, yields up 3 basis points. So that divergence of about 30 basis points between the two, and as we said in the headlines, the biggest inversion in terms of the 2s and 30s this century. It's a nice headline. Does it really matter?
Well, we have had a lot of debates about what the signal that yield curves and various inversions that we've seen the last few years really tell us, right? I mean, a lot of that, of course, is very structural. The market has changed quite a bit because of central bank bond buying over the last decade. But, I think this latest move really has been driven by the front end, those rise in 2-year Treasury yields, quite remarkable here as a result of repricing Fed expectations. But you know what they always say when it comes to yield curve inversions? It's not quite the inversion itself that matters. It's when it starts steepening, and once we get that kind of longer-term rate rise as a tighter monetary policy and higher Fed rates flow through to the real economy. There's always a bit of a lag, of course, when it comes to monetary policy settings and the effect that it has in the real economy. But that just speaks to the potential pain that we're in for probably over the next 6 months to a year as these rate hikes work their way through the real economy here.
Christine, thanks so much. Christina Kino there from our NLive team. Now, we're also joined by Sharon Bell, Goldman Sachs Managing Director for European Equity Strategy. Sharon, always great to speak to you, so thank you so much for coming on. How much of a correction are we still due in European stocks, given this rampant inflation?
Yeah, so we're probably more on the side of when we haven't finished this bear market yet. I was listening closely to what Christine said there. I also agree with her point that you can't trust these rallies at the moment. Our view is that valuation is still not quite cheap enough. Europe is a lot cheaper than the US, but the US is the market that really matters for setting the tone, and the valuation of the stock market there isn't particularly cheap, not even versus the last 10 or 20 years. So that's a constraint, I think, still. Rates, obviously, Christine covered that very well. You've got higher interest rates everywhere, really. Very hawkish central banks want to fight inflation still. Thirdly, I think you have still deterioration in growth. That's absolutely what central banks want to achieve, growth to come down so that they can fight this inflation. And then lastly, I don't think people have got bearishly enough positioned. And there's some signs of that. There have been lots of outflows from European stocks, but we've still had inflows into the US this year. So my view is we're not quite finished with this bear market yet.
Sharon, you're absolutely right. These rallies that we do see do look very, very fickle indeed. So what are the conditions you're looking at then to get a sense of when that trough is there in a material way?
I think probably the key things are one thing I think that's kind of necessary. It's not sufficient to get the market to turn, but I think it's quite necessary is cheaper valuations, particularly in the US. The multiples that we're on at the moment are still quite stretched. They're not as elevated as they were a year or two ago, but a PE for the S&P 500 of sort of 17, 18 times forward earnings is not especially inexpensive. So I think you need to get a little bit cheaper. When you have previous troughs, you were generally at lower valuations. And then the other thing is people need to be confident that the rate hiking cycle is coming to an end. And I think we are some way from that.
So what exactly, Sharon, is priced in at the moment in European equities?
So Europe, I do think, looks cheaper. Of course, I think you need to see a turn in global markets, and that really depends on the US. But Europe, I think, does look a lot more inexpensive. And the reason for that, of course, is that Europe has suffered from more problematic economic environment at the moment. High energy prices, very much a bigger spike in inflation, that hit to real incomes. The geopolitical risks are really centered around Europe. I think in the way the European markets performed, it seems to be discounting or implying growth slowing, but not a real recession yet in there. If I look at the way the markets perform, then it's sort of implying PMIs, the Purchasing Managers Surveys, in the high 40s, which is kind of where they are at the moment, but I think they could dip a little bit lower. So again, I think the European market's a bit vulnerable too. I wouldn't expect another 20% down in shares. I think that is quite bearish, particularly on European stocks. That would send them down to the kind of valuations they were on in the financial crisis. But a little bit further down, yes, I think that's the risk.
Okay, so Ray Dalio may be being a little overly bearish with that 20% call on downside for equities. Is there a play, Sharon, around European equities, stocks, companies that have sales exposure to the US on euro competitiveness?
I absolutely think there is. So the euro's collapsed, sterling's collapsed, and I think there's still a little bit of downside risk to those currencies. Absolutely, I think the companies, and this is one of the reasons actually European earnings in aggregate for the overall European market have held up quite well. There are so many companies with overseas profits in Europe. European companies are super international. Around, I think, slightly more than half of European company sales are made outside of Europe, with a very large proportion of that in dollars. So the companies with a lot of dollar exposure, those are the companies that will be gaining. Either they're gaining just because they're translating back all those lovely dollar profits into euros or sterling, or maybe they produce stuff in Europe, it's slightly cheaper, and then they can export it to the US and again make dollar earnings. So absolutely, I think the companies with a lot of international profits are doing relatively well and will probably continue to be.
Okay, Sharon Bell, Goldman Sachs, Managing Director for European Equity Strategy, stays with us. We'll get more of Sharon's calls after the break. And coming up, could there be limits to a no-limits friendship? She and Putin are set to meet for the first time since the Russian president launched his troubled invasion of Ukraine. We've got more on that story next.
And we're showing you live pictures from Westminster Hall, where Britain's Queen Elizabeth II lying in state. Thousands of mourners have been queuing through the night to pay their respects to the monarch.
Cryptocurrencies have been very popular. And if a client came to you and said, look, I'd like some cryptocurrencies in my portfolio, what would you say?
Oh, we've actually been really deep into crypto, deep into learning about blockchain, and all of the new businesses. You know, I would characterize this as crypto learners. You know, we have made a series of toehold investments on behalf of our clients, both in some of the currency baskets as well as with some venture firms that are investing primarily in the crypto area. I think it has the potential to be completely game-changing, but it is still such the Wild West, and it's so uncertain. But it has the potential to completely upend everything.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. The markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the Open, everyone. 14 minutes into the European trading day. This is the picture across the board. European stocks gaining some 0.3%. We did see a bit of a lift-off in certain parts of the markets yesterday as there was a dip buying opportunity. But you speak to a lot of investors and they say, look, a lot of the bad news also could not be priced in. One story that I really want to keep an eye on, Tom, is the fact that the UK, according to the FT, could scrap the banker bonuses to boost the City of London. This was, of course, an EU rule. When Brexit happened, a lot of people thought, maybe they'll get rid of it to attract top talent. And then there was a concern of public backlash.
Yeah, it's really interesting. This is the new Chancellor, of course, pushing for this. And presumably this would be the argument would be to boost competitiveness and bring in more talent into the City of London. So we're watching that story. Absolutely. Okay, now, as Ukraine makes gains on the battlefield, Russian President Vladimir Putin is facing narrowing options as he seeks to turn the tide in his struggling, nearly 7-month-old invasion. He's unlikely to be thrown a lifeline, though, from Xi Jinping when he meets the Chinese leader in Uzbekistan later today. Earlier this year, the Chinese leader spoke of there being no limits to their friendship. That statement will soon be put to the test.
Now, for more, we're joined by Bloomberg's Bruce Einhorn. Bruce, first of all, how has Putin's position changed compared to their last meeting in February?
Well, Francine, in February, President Putin went to China, met with President Xi. That was shortly before the invasion of Ukraine, a time when many people just assumed that Russia would make quick work of Ukraine, be in Kyiv in a couple of days, and it would be over. Of course, that didn't happen. Now, President Putin is about to meet President Xi in a very different situation. This meeting comes just as there's been this humiliating defeat for the Russians in northeastern Ukraine, with the Ukrainians in just a matter of days retaking territory that the Russians had spent months trying to get. We're now also starting to see some public criticism, not of Putin personally, but of his handling of the war from mainstream politicians, with the head of the Communist Party in Russia saying that there needs to be a change in the way they handle the war. He used the word war, which is notable because for a long time that was just not possible. You weren't supposed to refer to it as a war. It's just a special military operation. The difference being that if there were a war, then that would involve full mobilization, reaching many more Russians than currently, and so many more Russians would be affected by what's going on. That's something that Putin is loath to do at the moment, it seems.
Okay, Bloomberg's Bruce Einhorn on how the dynamic has changed, of course, for the Russian president, what that may mean in terms of the meeting with Xi Jinping later today. Again, our reporting suggesting that the Chinese leader is unlikely to step up in terms of at least military support for the Russian president. Right, still with us is Sharon Bell, Goldman Sachs Managing Director for European Equity Strategy. Sharon, we can't really talk about European equities without talking about the overlays of China. We've been hearing about support, fiscal support for that economy. We know Premier Li Keqiang is increasingly concerned about the plight of the Chinese economy. Talk to us about how you're thinking about the geopolitics, the risk of sanctions on China if they do get closer to Russia, and how you should be thinking about investments along those lines.
Yeah, it's tricky with China at the moment on a number of different points factors. China growth is pretty weak because of the zero COVID policy. You've also got the property market, which is deleveraging. That is also causing strains on the Chinese economy. So even as they ease credit conditions in China, you've got a very weak property market there, and that will take some time to delever, given the amount of debt through the system. And then you've also, you've had several years of declining birth rates as well in China too. There's just lots of different factors which make China growth quite slow. And then add on top of that concerns that if you do trade with China, then you could be more vulnerable as you were trading with Russia when sanctions were eventually imposed. So I think that there is a lot of issues there. We found that European companies with Chinese exposure have really underperformed this year.
Sharon, do you play China through exposure, for example, to some of, I don't know if it's energy or something in Europe, or do you actually cut some of your exposure because of lockdowns?
Yeah, so I think, as I said, Chinese stocks have already underperformed quite a bit. And that's true for the Chinese equity market itself, and it's true for companies, international companies exposed to China. So you could say quite a lot of that is discounted. The slower, weaker economic growth in China, and concerns about the property market and the deleveraging. So I think some of that is discounted by the market, but there are still some concerns. And I think that it's probably not an area that I would want to be excessively exposed to. I think you've got problems for every economy in the world, and we've been talking about this with tightening rates, and this is one of the reasons why I think that this bear market probably hasn't quite finished yet. We don't have a particularly clear area of the world where we can say that's the growth engine, that's going to do really well.
Sharon, I know you have a call in terms of being overweight energy, basic materials and financials. How much of this is about a dividend play, a return of cash to shareholders?
Yeah, I mean, all those three sectors, I think what combines them is their value sectors. They have good dividends as well. You got quite right to point out they have good dividends, they're value sectors, they're not so much growth sectors. They are, in some cases, a little bit cyclical. Financial certainly is cyclical, but benefits from higher interest rates as well. Oil companies, energy companies, they benefit from sort of a lack of supply of energy globally, really, and especially in Europe. There are some concerns about higher taxation for these companies, and I'm sure that will come through. But again, they do provide a very, very good dividend, as you say. So you're looking at the big oil majors across Europe, 5 or 6% dividends, plus share buybacks as well. The mining companies are a bit more vulnerable to China, our previous conversation, the property market there, concerns about growth there. But again, we need an awful lot of metal products if we're going to electrify our energy supply in Europe and globally too. So another area we see as undersupplied and indeed offering good dividends as well.
Sharon, how do you actually view energy in Europe? So this was the big story yesterday. There's also politically changes in Europe that will lead maybe to a confrontation with other countries that may support Russia going forward.
Yeah, so there's lots of things going on with the energy market in Europe, isn't there? There's potential, eventually you may see an end to this war. If you saw an end to the war and an end to the sanctions, then you might start seeing flows of gas again. I mean, we think in the near term that's quite unlikely, but it's a war, there's uncertainty. So that's one thing. I think the energy prices globally, they've come down a little bit as you've had sort of global growth weaken. I think the weaker global growth gets, the more that energy prices globally will come down. But the problem is it's still meeting a lack of supply of global energy. So while, yes, demand is coming down, you really don't have a lot of supply, particularly of oil, gas globally. And that's what's really caused all these spikes. So I think that those things still mean that the companies that own those assets should be well positioned for the medium term. So short-term risk with growth weakening, lots of uncertainty around the war, obviously, and the sanctions, but I think more medium term still very positive.
Sharon, thank you so much. Sharon Bell there, Goldman Sachs Managing Director for European Equity Strategy. Now, coming up, crypto's most anticipated update, Ethereum plans shifting its blockchain to a more sustainable model. We'll have plenty more on that shortly. This is Bloomberg.
everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
Welcome back to the Open, everyone. 25 minutes into the European trading day. This is a picture overall. We're seeing a little bit more green, certainly, than we did yesterday. 0.3% higher, and then quite a lot of stories that we're watching, including the UK set to scrap a banker bonus cramp. So that may give a bit of a lift longer term to the UK as we start understanding down the new policies of the new Chancellor.
Yeah, a boost there for bankers in the city, potentially. We'll see if that gets put into play. That is the reporting around the new Chancellor of the Exchequer, mulling potentially a scrap of that cap around bonuses. Some corporate stories to bring to your attention. Shell, we heard some rumours around this, some reporting around the CEO, Ben van Beurden, who's been in place for about 40 years, stepping down now. Now we have the confirmation. Stepping down at the end of this year, the head of gas and renewables at Shell, Wael Sawan, will be taking over, gains of 0.6%. H&M, it was a miss on sales. That's after Inditex came in pretty strongly yesterday. Slightly different picture for H&M, so the weak start to the quarter, but things are looking up, according to executives. And Kier Group, the property developer here in the UK, up 0.4%, despite the fact that they missed on adjusted revenue. They did say, though, that trading is in line with expectations, despite the inflationary environment here in the UK. Coming up, Europe's winter energy plan. We're going to bring you the details next. Stay with us. This is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are on Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
Welcome back to The Open, everyone. 30 minutes into the European trading day. Here are your top stories. Cash in or cash out? Carlyle's David Rubenstein says it's time to buy the dip. Bridgewater's Ray Dalio warns of another 20% plunge in equities. Brace for a hard landing. The 230 Treasury curve hits its most inverted this century as short-end yields jump. Stocks recover after their brutal sell-off. Plus, energy intervention. The EU unveils its crisis plan, but shelves ideas of price cap, while the ECB's Holtzman warns inflation is set to accelerate even more. So, Tom, if you look at the markets, actually they're pretty sanguine in the face of this accelerating inflation. And as we look at second and third round effects.
Yeah, 2 days of losses for European equities, turning around though today, as you say, up 0.4%, following the gains that we saw yesterday from the US. Just how convincing is that rally going to be, though? Is it a bear market buyback that we saw out of the States yesterday? Gains of 0.4% across the benchmark. The DAX over in Germany up 0.5, helped by the auto sector. Here in the UK, the FTSE 100 up 0.6% or 42 points. We're looking ahead out of the US to retail sales later today, and then the Michigan University survey, sentiment survey on Friday. Let's switch it over, see how playing out across those sectors. And I talked about the auto sector. It's one of the leading sectors this morning. Basic resources also up. A little bit of relief. Some news out of China as well, that the mega city of Chengdu is going to be easing some of those restrictions. So we'll see whether that plays in to the oil space, commodities like iron ore in particular. Banks at the top of the list. The sell-off in bonds yields are up this morning. That continues, that grind higher for the US 2-year, 380 and above. Do we get to 4% in the weeks and months ahead? Banks up 1.65%, a beneficiary, of course, of higher yields. Basic resources, as I mentioned, tying into the China story somewhat, up 0.9%. Just one sector in the red this morning. It is utilities, down 0.6%, linking to what we're hearing around the energy crisis plans from the European Commission, Fran.
Now, the European Commission, as you say, has proposed to member states a raft of regulatory changes to alleviate the liquidity squeeze in the energy sector. This comes as the continent ramps up support to industries and consumers affected by Russia's throttling of gas supplies.
The design of this package is extraordinary. So this is an emergency intervention package, temporary package, but we use like special article in our treaty. And that means that member states will be able to find agreement very fast. I truly hope, and I saw a willingness among our ministers that they will support the measures that we propose today, and that actually helps them to support their consumers and also to avoid situations where we will have blackouts or need for curtailment.
Okay, that was Energy Commissioner Kadri Simpson speaking exclusively to Bloomberg's Maria Tadeo. Let's speak to Maria now for the latest. Been following the twists and turns of this, the proposals from von der Leyen yesterday. Maria, what stood out to you? What do we know about these proposals and how likely they are to actually be signed off?
Well, Tom, to me yesterday, this was a full day in Strasbourg as a State of the Union, and usually this is a speech that, of course, signals a political direction for the Commission, and there were two key messages for me, in my view. One of them, of course, is that we're moving into something that looks like a war economy for Europe. When you hear this need of avoid blackouts, potential rationing, demand destruction that will become mandatory in some extent. There will be binding targets. This idea of a solidarity contribution, which in many ways is a tax. A lot of this is designed to prep the public opinion for a very difficult winter. And I think that was a takeaway yesterday from a lot of officials that I spoke to behind the scenes. This is the start of something that could look like a war economy going into the winter. And then the other point is the sanctions. You know, I asked the Energy Commissioner twice, what if there's social pushback? What if people don't want to pay this bill? Will you keep the sanctions on? And she repeated, yes, we have to. The price of not doing that would send the wrong message to Russia. The sanctions are not going to be changed, and Vladimir Putin needs to understand that.
Maria, thanks so much. Maria Tadeo there with the very latest, of course, on this great conversation she had with the Energy Commissioner. Now, we're joined by Fitch Rating Head of EMEA Natural Resources and Commodities, Angelina Falavina. Angelina, thank you for joining us. First of all, we're looking at possible very fractious debates between the member countries. We're probably looking at fights as some have regulatory concerns, others have a different energy composition. What does it mean for the utilities and energy companies in all of these countries?
Well, obviously, in order to implement a very comprehensive package of different measures, it takes time to develop those measures and then to reach agreement among different EU countries. What we've seen so far is the deliberations across, first of all, the introduction of the windfall taxes on the energy companies, the power generators, which are non-gas power generators, and also oil and gas companies. And this is something which we have already expected, and we incorporated in our financial models, because the energy power prices, the gas prices are exceptionally high, and these companies are generating very high cash flows. The other set of measures are related to the end consumer, to introduce a cap at which power is sold to the end consumers. Again, this is something which we already anticipated because of the very high level of the power prices. But there is another set of measures which is being considered, and this is to delink the power markets from the gas markets. And there were some ideas about the introduction of a different benchmark for the gas market. Currently, the gas benchmark in Europe is TTF. It's NBP in the UK and Henry Hub in the US. Yep. And so in the EU, the idea was to introduce another benchmark which may put a certain cap on the gas prices. And this is something which we're watching, because obviously the gas benchmark is a market benchmark.
Angelina, on pricing, you're seeing Dutch prices edging up again today, about 7% higher, obviously, significantly higher, but not remarkable given the moves that we've seen recently. The gas prices have come off the highs of around mid-August, though. What do you see in terms of the trajectory for prices, given the proposals out of Brussels?
Well, at some point in time, when there were discussions about these proposals, there was a small downward correction in the gas prices in the TTF benchmark, but then it ticked up again. The prices are exceptionally high. We expect them to stay at those levels because the gas flows from Russia are at a minuscule level, and there is a high risk that they will be fully cut off. So for this year, we're anticipating the average, it's just the average TTF at about 45, 47, roughly $50 per MCF. And we do expect them to remain at very high levels for next year. Having said that, there are various aspects here. The first one is if the demand destruction continues as planned, and we've already seen quite a few indications of that. For example, in the EU, overall demand reduced by 11% in the first 5 months of this year. And then in some countries, the demand destruction was high. For example, in Germany, it's 13%. And there is a level set by the EU, the voluntary level as of now, at 15% overall demand destruction. So we believe it's achievable. So if demand destruction continues as planned, and if the measures put in place on the supply side are also successful, meaning that the LNG volumes are coming and then the other alternative sources of gas are coming to the market, then potentially there may be a downward pressure on the TTF. Because if you look at the difference between the NBP and TTF, it's quite substantial. NBP is half of the TTF. And the reason for that is that UK is more self-sufficient in gas and obviously can import LNG. Right. So as soon as the market sees that the measures work, there may be a downward pressure on the prices.
Yeah, so what's the optimum way? If you're, at the moment to, for example, talk to a finance minister or an energy minister and say, what's the optimum time and the optimum way of trying to reduce and get away with some of that demand destruction? Is there an optimum ratio of how much you need demand destruction and support for families?
So based on our calculations, if we assume demand destruction by 15%, which is sort of the voluntary target, which is currently in place, and there is no Russian gas at all, we believe that the EU can balance its gas markets. But this is subject to weather conditions. We are assuming that the weather is average. If the weather is as cold as it was in 2012, then it will add 5% to demand, and obviously the market will be tighter. But in order for this ratio or for this balance to be reached, obviously quite a few things need to happen. So the LNG has to continue flowing, the demand will have to sort of remain at a low level, but we are entering the winter time, and this is when the demand is increasing quite substantially.
Yeah, the dependence on the weather, a 5% increase in demand if we get a cold winter, is the assessment then from you and the team. When it comes to what we're seeing with Uniper, this was the news that broke yesterday, confirmation today that indeed they are in talks with the German government about a full takeover there by officials in Berlin. Is this the new template, do you think, for utility companies across Europe? How much do you read into what is happening with Uniper?
So obviously the utility companies, especially the companies which are exposed to the supply business or to the contractual agreements with Gazprom or to the spot gas markets, they're obviously heavily affected. And Uniper has already been in negotiations with the government for quite a while for the potential support. So given the situation in the market, and it's quite extraordinary, so the state will consider various options and various possibilities to support the sector, either through the regulatory measures or through the liquidity measures. For example, if you look at the package in the UK, there is a liquidity support to the companies, and this is something also the EU is considering, especially given how the hedging works in the market.
Okay, Angelina Valavina, important insights. Thank you. Fitch Ratings head of EMEA Natural Resources and Commodities on the back of those proposals from the European Commission President yesterday, what it may mean in terms of addressing this energy crisis. Coming up, DHL, a Worldwide Express CEO, John Pearson, will be talking to us about supply chains, just how resilient they have been post-pandemic, what it means for global trade.
And we're showing you live pictures from Westminster Hall, where Britain's Queen Elizabeth II is lying in state. Thousands and thousands of mourners have been queuing through the night to pay their last respects to the monarch.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
Welcome back to the Open, everyone. We're 43 minutes into the European trading day. Stocks a little bit mixed. Investors, again, weighing the prospect of some pretty large hikes from the Federal Reserve, but also the ECB. Not as large, but actually could go on for longer. Treasury yields and the dollar pretty much edging higher. Now let's get straight to the Bloomberg First Word News with Laura Wright. Hi, Laura.
Hi, Francine. Ukraine's Volodymyr Zelensky has visited Izium, the biggest city recaptured from Russia last week, during a counter-offensive in the country's northeast. A car carrying the president collided with another vehicle on the way back to Kyiv. Though Zelensky did not suffer any serious injuries, separately, EU President Ursula von der Leyen has pledged to work towards seamless access for Ukraine to European single market. President Xi Jinping has traveled to Kazakhstan for a state visit, his first foreign trip in nearly 1,000 days. The trip marks Xi's return to the world stage after being the only G20 leader to avoid leaving his country since the first COVID lockdown back in 2020. The Chinese president is set to meet Russia's Vladimir Putin in Uzbekistan later today. Swedish Prime Minister Magdalena Andersson has conceded defeat following Sunday's election and will resign. A surge in support for a nationalist party helped the right-wing opposition win one of the country's closest elections ever. Andersson became Sweden's first female prime minister less than a year ago and led a historic bid to join NATO following Russia's invasion of Ukraine. Talks aimed at averting a U.S. rail system shutdown have continued into the early morning. Around 125,000 workers could strike on Friday if there is no agreement. U.S. Labor Secretary Marty Walsh is leading the negotiations between unions and freight rail companies. Amtrak says all long-distance trains are currently cancelled. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Francine.
Laura Wright, thank you very much indeed. And that story, a reminder of some of the implications around trade, transportation, of course, being affected in the US, and maybe an implication when it comes to inflation. Now, global trade has been surprisingly strong despite recent shocks and growing pessimism. That is the conclusion of a study carried out by DHL and NUY's Stern School of Business. Global trade has faced, of course, a number of headwinds in recent years, including no less than the pandemic, and now the war in Ukraine, which have both disrupted production and hit supply chains. Now you have industrial action. We're seeing that again in the US today, at least the ramifications of that. DHL Express CEO John Pearson joins us now. John, what are the key takeaways for you then? There's some resilience in the global trade environment, in supply chains that maybe has been underappreciated. What does it tell us about that resilience and how we are positioned for the months and quarters ahead?
I think underappreciated and skepticism is exactly the right word. I think, good morning to you and your listeners from Brussels, where we're releasing the Global Trade Atlas today for the very first time in conjunction with our decade-long study in the level of global connectedness. And the summary of the Global Trade Atlas is that there is more, faster, broader, and changing. And I just talked to that for a couple of minutes there. There's more trade than there was pre-pandemic. The trade this year and next year is forecast to grow faster than pre-pandemic levels. The broadness talks to the nature of emerging economies and how they're getting a bigger slice of the pie. And the changing is the one I'm particularly interested in, is the fact that the emerging economies story is now firmly built on quality and not just necessarily quantity that it might have been a decade ago. They're taking the benefits of connectedness, they're taking the benefits of innovation, they're taking the benefits of digitalization, putting into the pot and making very precise and high-tech and innovative equipment that they're then exporting to the rest of the world. And the catalyst and the accelerant of all that, and it comes quite clearly through the study, is e-commerce, which is now into its sort of 7th or 8th year of quite stratospheric growth and was precipitated by the pandemic.
When you look at the supply chains in Europe, because of these higher energy costs, because of rationing in Germany, but also other countries, are you going to see some of those components that maybe used to be bought in Europe move elsewhere? So does it put further pressure on these supply chains?
I think that the supply chains have been built up on efficiency and economics. There's a little bit of There's some diversity required in those supply chains in terms of there's some clear evidence of China plus one and China plus two. And I think the nature of people's supply chains is dictated to a little bit by some of those rising costs. But one of the other things that the study absolutely confirmed, and the Global Connectedness did the same, is that the nature of long distance trade, the kilometer distance transversed by trade, is basically 5,000 or 5,000 plus kilometers, which it was a decade ago. So that great sort of east-west trade route is still very much in place, and that delivers upon the requirements of efficiency and economics, which is what companies want to take their products to market at the most marketable cost, despite any levels of inflation caused by fuel, energy, or anything else.
John, you touched on e-commerce and the growth of that part of the business, particularly when it comes to DHL. I'm just thinking there's a couple of big events coming up, shopping events. A lot of that will be done online, of course, whether it's Christmas or Chinese New Year or Black Friday. To what extent is the logistics business prepared for that? Is the logistics industry, is it over the struggles and the strains that we saw during the pandemic?
Yeah, so I think that's a great question. You know, what is peak season going to look like, and are people ready for it? We've spent the last 2.5 years finding more aviation assets that we could put into our network. In fact, we've added 80 or 90 new aircraft into our fleet since the last 2 years, and we've needed every single one of them. Capacity, 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 that gives lift, that gives quality, and that allows us to be prepared for peak season. There is always a hockey stick for peak season, which is defined by October 1 for DHL Express. The elevation of the hockey stick this year is completely unknown, and whether consumers start buying again rather than browsing. But what I can tell you is that every single merchant that started trading with us during the pandemic, when we had that 3 years of growth in 3 months, is still with us, trading at much lower levels. So those sort of nascent customers are ready to uptick again. But what the peak season really is like, we don't know.
So how worried are you about inflation? And actually, does it mean that people will go to stores instead of shipping, or that also some of your customers will have to go bust?
Oh, I think global trade, you know, and the demand is, you know, proven to be very resilient. You know, from our point of view, it puts pressure on the supply chain, the fuel cost, which we have a natural mechanism of recovering that in terms of our fuel surcharge index, does put pressure on shipping. But people have moved over to express transportation for reliability of movement, for consistency of service quality, and for most of all, consistency of pricing, in that our customers only hear from us once a year in January, and then the prices are very stable and structured for the balance of the year, and they appreciate that in their planning very much.
Okay, DHL Express CEO John Pearson, thank you very much indeed on the state of global trade and the logistics industry, particularly as we head up to some key shopping seasons. Thank you.
Now, coming up, Bloomberg Green is launching a new podcast. It's called Zero, and it explores the tactics and technologies taking us to a world of zero emissions. It's hosted by Akshat Rathi, with new episodes from Akshat and the team available every Thursday for download. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising. surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Crypto's most important commercial highway, Ethereum, just got repaved. The blockchain network completed the crypto world's biggest and most ambitious software upgrade to date. That is according to its co-founder, Vitalik Buterin. For more, we are joined by our senior crypto reporter, Joanna Ossinger, who's going to explain what is happening with the merge and why it's important. Joanna.
Yeah, well, basically, it's done at this point. As of about an hour ago, we have it's all done. It seemed to go pretty smoothly, so that must have been a relief to the developers who'd been working for years on this stuff. And, you know, it seems it was almost a non-event in how it happened. Everything seems to have gone kind of by design, at least to this stage.
So, Joanna, how has the market been reacting now that the merge has happened?
Well, it's a tentative thumbs up, Francine. I guess that's the way to say. The Ether is up just a little bit, but you know there wasn't a big move up or down. Some people thought it might be buy the rumor, sell the news. Some people thought it might be that everyone would be so excited once it was done and the cloud of uncertainty was removed. But really, it just hasn't moved all that much. There were a lot of people hedging in the derivatives market, for instance, about the uncertainty. So it could be that people are just waiting to see what happens in coming weeks. But it has been almost a non-event from a market's perspective.
Okay, you're seeing about a 1.7% gain for Ethereum, currently trading at 1,631. The idea, of course, to reduce energy consumption. They're saying it's going to cut that by about 99%. Joanna Ossinger for the latest on the Bloomberg, on the merge, I say, not the Bloomberg merge, the Ethereum merge. Thank you very much indeed. Plenty more coming up. Stay with us. This is Bloomberg.
Of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrow. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
We have diversified our gas supplies. We have secured sufficient levels of underground gas storage. We do have companies who are addressing exactly this demand response, and this is a way forward.
I want to make it very clear. The sanctions are here to stay.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Cash in or cash out? Carlyle's David Rubenstein says it's time to buy the dip. Bridgewater's Ray Dalio warns of another 20% plunge in equities. Brace for a hard landing. The 230 Treasury curve hits its most inverted this century as short-end yields jump. Stocks recover after their brutal sell-off. Plus, energy intervention. Now the EU unveils its crisis plan, but shelves ideas of a price cap. The ECB's Holtzman warns inflation is set to accelerate even more. So good morning, everyone. First of all, let's check on the markets because interesting dynamics that we're seeing overall. Stocks pretty much mixed. Again, investors weighing the prospects of large interest rate hikes by the Federal Reserve. Treasury yields actually rising. The dollar pretty much little change. Now, European stocks up in Europe. Banks are outperforming. Utilities slumping. So this is the picture for European stocks. If we look at the difference, for example, in the market between countries such as the UK or Italy. I'm so choked up because finally we're seeing some gains across the board. We look at exactly what it means, of course, for ECB hikes as well. Retail sales due in the U.S. today, and the University of Michigan readings tomorrow will, of course, be parsed for clues about the strength of the economy and inflation expectations. So European stocks higher this morning, recovering some ground after the rout. The 230 yield curve, harbinger for a looming recession, meanwhile, has deepened to levels last seen in the year 2000. Now we're joined by Catherine Young, Investment Director at Fidelity International, and Christine Aquino for our markets team. So thank you both for joining us. Christine, what are we looking at away from inflation? There's nothing else really, right? It's all about the strength of the U.S. economy, what it means for the Fed, dollar strength, and the rest of the world.
Absolutely, Francine. I think, yeah, we're biding a little bit of time here before the next key event coming up next week, of course, that Fed rate decision. And then right after that, the Bank of England rate decision, which was delayed a little bit due to the Queen's passing. But yeah, it is still very much a conversation about how much more policymakers will really have to do. I think the U.S. inflation numbers really just showed us this week that it's going to take a lot more than what the Fed has already done, and really what a lot of central banks have already done. Because even in the UK, while inflation pulled back a little bit and maybe it was slower than expected, it's still very much near those historic highs, and it just really calls for unprecedented policy response.
Catherine, what's your take on inflation? How aggressive will these interest rate hikes be from the Fed?
Well, even if we see absolute inflation ex-China, sort of reach its peak or meet its inflection point, the central bank policy is still way behind. So it is still a risk, as we've been just discussing. And again, what's very interesting is ex-China, so inflationary pressures aren't as significant in this part of the world.
What does that mean, Catherine, for where you want? Are you buying the dip at the moment, or are there parts of the markets that look attractive?
So in terms of the Chinese market itself, there's so much negative news flow that's been priced in for well over a year, 18 months now. So there are some opportunities. You're finding opportunities across the board. But having said that, we don't think we're going to see this big divergence that we have seen over the year in terms of value versus growth. So it's not like value is going to outperform 10% over growth names, or in 2020 we saw the reverse where growth was outperforming value names. It's going to be more of a mixed bag. But having said that, in this kind of environment, looking for companies with more visible earnings profiles that have that defensive business nature, and all importantly, that dividend yield are really, really key.
Christine, when you look at some of the concerns out there, so of course it's China, it's one of real estate, do we feel that the policymakers will at this point maybe reverse course and do everything they can to sustain it?
Well, as far as China is concerned, we definitely know that they very much want that supportive policy, right? I mean, there is a reason why I think we're seeing a lot of pushback, for instance, against a weaker yuan. But at the same time, Chinese authorities really emphasizing that support for the economy via other measures. And so there is very much this sense that the Chinese government really wants to kind of see the economy through such a really difficult time. I mean, between lockdowns that have been, they've been in and out of lockdowns, demand, it really has been slowing to a great degree. We're seeing that getting borne out in the economic data. It really has not been a great year for China.
When you look at, Catherine, at some of the concerns surrounding China, I don't know whether geopolitics, of course, it's something that we need to keep a bit more of an eye on, given Vladimir Putin with President Xi today.
These geopolitical issues, especially between the two largest economies in the world, are likely to continue as you see both economies really trying to increase their global market share, especially from a high-end manufacturing perspective. And even from a regulatory perspective, whether it's the ADR issues and the disclosure there or the executive order, you're probably going to still get these periods of volatility. And again, a lot of this is priced in, but in terms of the key areas of risk for China, it's this ongoing impact of the lockdowns on both sentiment as well as productivity. And in terms of just, the other risks, again, slightly different from the rest of the world, but the PBOC or the central can't ease too much because the interest rate differential will just become bigger and bigger as other central banks aggressively tighten.
So, Catherine, what does that mean for renminbi?
Again, you're probably going to see, it's good seeing a depreciating RMB, right, for the exporters, and China continues to be a huge exporter. But then what does it mean from a flows perspective and also from a sentiment perspective? So again, you're probably going to see the PBOC or the regulators really closely look at the range in terms of what the RMB will do. So no massive shifts, but again, it's going to be probably quite range bound.
All right, thank you so much both for joining us. Christina Aquino from our markets team, Catherine Young, Investment Director at Fidelity International. Now, coming up, could there be limits to a no-limits friendship? Xi and Putin are set to meet for the first time since the Russian president launched his troubled invasion of Ukraine. So we'll have plenty more on that story. And of course, we continue watching some live pictures from Westminster Hall, where Britain's Queen Elizabeth II is lying in state. Thousands and thousands of mourners have been queuing through the night to pay their respects to the monarch. This is Bloomberg.
Cryptocurrencies have been very popular. And if a client came to you and said, look, I'd like some cryptocurrencies in my portfolio, what would you say?
Oh, we've actually been really deep into crypto, deep into learning about blockchain, and all of the new businesses. I would characterize us as crypto learners. We have made a series of toehold investments on behalf of our clients, both in some of the currency baskets as well as with some venture firms that are investing primarily in the crypto area. I think it has the potential to be It's completely game-changing. But it is still such the Wild West, and it's so uncertain. But it has the potential to completely upend everything.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, as Ukraine makes gains on the battlefield, Russian President Vladimir Putin is facing narrowing options as he seeks to turn the tide in his struggling, nearly 7-month-old invasion. Now, he's unlikely to be thrown a lifeline from Xi Jinping when he meets a Chinese leader in Uzbekistan later. Now, earlier this year, the Chinese leader spoke of there being no limits to their friendship. That statement will soon be put to the test. Now, for more, we're joined by Bloomberg's Bruce Einhorn. Bruce, what does China need from Russia, and what does Russia need from China right now?
Well, Francine, they did announce this no-limits friendship partnership back in February. That was when the two presidents met at the time of the Beijing Olympics. Of course, it was right before the invasion of Ukraine, which has not gone according to the way that Vladimir Putin presumably thought it was going to. So he's going into this meeting with a much weakened hand, much weakened position. China has offered some support, certainly rhetorically. China has supported Russia, has blamed the United States for the war in Ukraine. A top Chinese official recently said that Chinese leaders fully understand the necessity of Putin's actions. Chinese companies have expanded some trade with their Russian counterparts, but you're getting back to the idea of there being no limits to this partnership. Maybe there are some. China has not, as far as Western intelligence has been able to tell, or at least publicly say, offered military support to Russia, hasn't offered significant financial aid. Chinese companies are concerned about getting hit with retaliatory secondary sanctions from the U.S. and the EU and other allies. So China has helped, but probably not nearly as much as Vladimir Putin would have expected at this point.
So in comparison, how, overall, has the situation changed from February?
For Xi Jinping, he's also in a different situation. It's hard to say whether it's stronger or weaker. Certainly, compared to February when the leaders last met, Xi Jinping has had to deal with significant amount of COVID outbreaks in China, including the outbreak in Shanghai, which led to a 2-month shutdown of the city, significantly affecting Chinese growth. Xi Jinping has not backed away from the COVID-0 policies. The city of Chengdu in Western China just recently has gone through a lockdown only a few weeks as opposed to a few months, though. So Xi Jinping might be able to point to this as a sign that, look, his zero-tolerance strategy for COVID is working. That said, it is taking an impact on the Chinese economy. So a slightly weaker China going into this meeting with Russia, but a significantly weaker Russia going into this meeting.
All right, Bruce, thanks so much. Bruce Einhorn there with the very latest on the meeting between President Xi and Putin. Now we're back with Krafing Jung, Investment Director at Fidelity International, also with us, Christina Kino from our MLive team. Catherine, we were talking a little bit before about China. This, of course, is your expertise. What does this China influence and really the standing up to the U.S. means for their relationship and their economic ties with the emerging markets, neighboring emerging markets to China?
Yeah, I mean, it's critical. And, what happens in China, whether it's policy-wise or growth-wise, does have an impact on its neighbors, which then also has a knock-on impact in terms of emerging markets. So we can't underestimate the influence that China does have from a global perspective. But if we look domestically, and Christina mentioned this as well, what's key from a policy perspective is really to ensure confidence picks up again and to really ensure that the economy is back on track. And what's really fascinating to look at is we all talk about the rise of the Chinese consumer, but what's going to become very important over the future is the rise of the Chinese investor. So looking to see how they invest, especially with the dynamics in the property market. That's why we believe that the development of the capital markets is going to be critical in terms of growth going forward.
Catherine, overall, when you look at the supply chains and how far they've changed because of COVID, do they change further because of energy prices in Europe? Do they move around? I know this is usually supply chains that take like 5-10 years to move.
Yeah, China, because of its expertise in manufacturing and the infrastructure itself, they really dominate the exporting perspective. And they also import a lot of raw materials. So a lot of the raw material prices is very dependent in terms of the demand coming out of China. In terms of the supply chains, I mean, China continues, even if we look at the lockdown situations, when you do see lockdowns these days, you still see this sort of exemption in terms of productivity and manufacturing. So leisure, restaurants, all that kind of part of society tends to close down, but manufacturing is still able to go ahead. So they are cognizant of the supply chain. But, when I mentioned earlier about the geopolitical nature, as China continues to increase its presence in a number of high-end manufacturing spaces, this is going to see further competition, not just from the US, but other areas such as Europe.
Thank you so much for joining us, Catherine Jung, their investment director at Fidelity International. Now, we're also joined, of course, by Christina Kino to look at the other things that we're watching out for is really dollar, right? Anything that you have, this dichotomy between the U.S. and China is extremely important. And this inverted yield curve, I don't know how we live through this. I know that the 210 is something that we talked about. It's not necessarily impending recession. Then the 3-month 10-year is also ugly.
Yeah, Francine. I mean, that really is kind of the story, right? It has been one of repricing those Fed expectations, which really is more pronounced in the front end of the yield curve, thus the inversion that we're seeing at the moment. But again, when it comes to inverted yield curves, the warning sign really is not so much the inversion in and of itself, but when that curve starts steepening and those borrowing costs across further out in curve start rising as well. That's really when it starts flowing through to the real economy. That's when you start seeing that tightening in financial conditions that really the Fed wants to engineer to be able to kind of bring down the level of inflation that we're seeing at the moment. Of course, whether that causes recession, how much of a hard or soft landing we're going to see on the back of that would be the key question for a lot of investors at the moment, and still very much up in the air.
What does this all mean for dollar?
Well, the dollar has been on such a relentless stare, but I do note that what some of the key developments more recently is really that more pronounced pushback from some of the world's biggest economies, Japan and China, both again showing less of a tolerance now for the weakness in their own currencies and strength in the dollar. Again, we've talked about, what really could stop the dollar in this in its tracks, and it possibly could be something of a concerted effort from the biggest economies in the world, pushing back simultaneously against the dollar. It may not be sort of a Plaza Accord type agreement where they're all doing it all at the same time in a coordinated way, but if we do see kind of more of that simultaneous pushback from other countries apart from China and Japan, we could really see a bit of a turning of the tides here for the dollar.
Because the other thing that we really need to focus a little bit on, I know we have maybe for different reason, is the fact that the Chancellor of the UK seems to want to unleash this Big Bang 2, right? This Reagan-style regulation. We hear today also about banker bonuses. Is there, if a currency is a share price of a country, what are we expecting for sterling?
Yeah, well, it's going to be interesting, right? I mean, this pro-growth push, in theory, should be positive for sterling, but I think there are kind of more immediate underlying issues that are weighing on a currency at the moment. Most importantly, of course, what we're about to face this winter. We're in the middle of a cost of living crisis, and more importantly, we're about to face kind of a bit of an energy crisis, as is the rest of Europe at the moment. And so, you know, well and good, I think that the chancellor is trying to really gear the country toward that growth mindset, that growth perspective. But I think the immediate thing that sterling really has been weighed down by is the fact that consumers aren't doing so well at the moment. We'll see if Liz Truss's plan to cap energy costs for households and businesses, we're going to see more details of that in the coming weeks. We'll see if that kind of shores confidence enough among UK consumers that into next year, this growth sort of perspective really comes through.
Christine, thanks so much. Christina Aquino there from our markets team. Coming up, Europe's rate setters double down on their pledge to drive down inflation as Europe braces for further energy price pain this winter. We'll get into that with former ECB President Jean-Claude Trichet. That interview coming up shortly, and this is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Virginia Governor Republican Glenn Youngkin says Biden's policies are leading to persistent inflation. Take a listen.
I am really concerned about the inflationary policies that we see coming out of the Biden administration. And Tom, we see the ramifications of that yesterday, which is anybody who thought that this was going to be short-lived has been shaken, because what we're seeing is the persistent result of bad policies, inflationary policies, with grocery prices up, fuel prices up, and Virginians and Americans feeling it in their wallet, and they're having to make compromises as a result.
We have iconic American companies moving, for instance, from Chicago to Greater Washington, D.C., translated Virginia. We've got entrepreneurial companies such as your announcement today on an innovative company And on a wage basis, they're competing with Amazon, who's lifting compensation for drivers in hundreds of thousands of their employees. Is there a wage spiral in Virginia?
Well, there is a real wage inflation challenge. These wages are growing, but they're not growing as fast as inflation and the cost of living. I'm really excited about these new companies that are coming, like Plenty Unlimited that we're announcing today, that is going to build the largest indoor growing facility in the world. And we're going to see them right here in Virginia. They're going to compete for talent. This is why we have to get people back into the labor force. We've seen labor participation drop substantially in Virginia. We were up near 67% prior to the pandemic. And unfortunately, we dropped and we're in the 63.5%-ish now. We got to get people back to work. These great jobs, these next generation kinds of opportunities will pull people back into the workforce, but we've got to stop all of the underpinnings that have encouraged them to stay home and out of the workforce and get them back to work.
Governor, this indoor vertical farming company and the indoor vertical farm that you're espousing really speaks to an agenda more commonly associated with the Democrats in terms of trying to make things greener, make things more modern with respect to the carbon footprint. Do you find yourself bumping up against that stereotype when trying to have a more modern approach that brings in more young workers?
Well, not really. I mean, agriculture is Virginia's largest private industry, and technology is one of our fastest growing sectors. And so to bring agriculture and technology together in the Commonwealth of Virginia makes perfect sense. And in fact, we have absolutely become the hub. With today's announcement with Plenty, which is going to build a $300 million facility right outside of Richmond, 300 new jobs, and our announcement 2 days ago with AeroFarm, we will have the first and second largest indoor growing facilities in Virginia. And yesterday we announced another company, Beanstalk, expanding their facilities. So we're bringing together our agriculture roots, our technology future, and forging the way for an industry of the future. Ag tech uses far less natural resources, has higher yields, and a great product. And I just think this is part of the future of agriculture. It's happening right here in Virginia.
Well, that was Virginia Governor Republican Glenn Youngkin. Coming up, Europe's rate setters double down on their pledge to drive down inflation as Europe braces for further energy price pain this winter. We'll get into all of this with the former ECB President Jean-Claude Trichet. That interview next.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Cash in or cash out? Carlyle's David Rubenstein says it's time to buy the dip. Bridgewater's Ray Dalio warns of another 20% plunge in equities. Brace for a hard landing. The 230 Treasury curve hits its most inverted this century as short-end yields jump. Stocks recover after their brutal sell-off. Plus, energy intervention. The EU unveils its crisis plan but shelves ideas of a price cap. The ECB's Holtzman warns inflation is set to accelerate even more. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Europe is grappling with a crippling energy crisis and scorching inflation that continues to pose a problem for the ECB. Central bank officials are doubling down on their intention to fight inflation. Now, while François Villeroy de Galhau thinks the ECB needs to focus on hitting the neutral rate, near 2%, and then assess, Chief Economist Philip Lane signals further hikes will be smaller after last week's jumbo move. Now, let's get through the thoughts of former ECB President Jean-Claude Trichet. Mr. Trichet, as always, thank you so much for joining us. I have many questions, first of all, on how impossible or difficult it is to find a neutral rate, how difficult it is to deal with the second and third round of inflation effects, of course, of this energy crisis. What do you see the most difficult set of data that the ECB has to analyze right now?
I think that the ECB is very, very clearly concentrating on inflation expectations and the anchoring of inflation medium-term expectations. I would say the moment where you have to stop increasing rates is the moment where you clearly have regained control of the inflation expectations. And of course, neither on this side of the Atlantic nor in the US, you know in advance exactly at which moment and at which level you will be in that situation. That's the reason why, when asked the question you just asked me, the response of the central banks is, we will see. In any case, we are on our way to regain control, and I trust that they will regain control of expectations.
But, Mr. Trichet, how difficult? This is a supply-side shock. We're essentially at war with another nation that holds so much energy. Does this show us really the limited scope of any central bank?
I think that what you have to look at very, very clearly is more the underlying inflation, the core inflation, than the apparent inflation, all taken into account, including oil and gas and agro products. And clearly there you have a level which is very, very worrying. On both sides of the Atlantic, again, you have more than 6% on the one hand in the US, 5.5, around 5.5 in continental Europe, in the euro area, and that, of course, signals a level of inflation without oil, without gas, without the agro product. That is something which signals a high level of inflation. So you have to concentrate, and it is, in my opinion, what the ECB is doing, on avoiding the second round inflation, the second round price increases, which contaminate the full body of the constellation of prices. And they concentrate on that, and they have to be very credible to regain control of this very, very important, I would say, second round that are there already, unfortunately.
But, Mr. Trichet, are we looking at stagflation in Europe? And again, is this worst-case scenario, like nightmare scenario for any central bank?
Well, again, I take it that the worst scenario is very clear. You lose control of inflation, you're back to, say, the Fed in the 70s and the beginning of the 80s, and you have to regain control in the worst possible circumstances. You have to put rates like Paul Volcker did at 20% to regain control, to break the back of inflation. So it is what the ECB is trying to avoid, of course, and to avoid the worst. So even if there is a period of time where you have some kind of slowing down of growth, which is in the cards, obviously, then you still have to avoid the second round effects. You still have to regain control of inflation expectations. I think we should not mix the two. In any case, the banks are doing what they should do in the present circumstances, taking into account, of course, the level of inflation. You also to take into account, in any case, if you take the real rates, of course, you have still on both sides of the Atlantic real rates on a short-term basis that are negative, on a medium-term basis that are very close to negative, and also and not on the long-term basis, because I make the assumption that 2% will be around 2%, say, will be the right inflation in the medium long term.
Yeah. But Monsieur Trichet, so how aggressively and how fast do rates have to increase in the Eurozone to make sure that actually we break inflation's back before things are out of control in the Volcker style?
Well, again, as you might remember, they had anticipated 25 basis points when in July. They did 50. The market and many observers had anticipated 50, and they did 75 in the last decision. We will see what happens. In any case, again, the problem is regain control of inflation expectations and still understand that starting from zero remember, the interest rates were minus 50 basis points before July. After July, it was zero. And now it is 75 basis points. So in any case, we are still at a low level. So we will see. I make no, I would say, projections at all, and I have no advice for the ECB. I would only say it's clear. Regain control of inflation expectations is the rule of the game.
Do you worry about many companies actually having to go bust? So if not zombie companies, when there is such a rapid progress in interest rates, sure from a low level, but in a very short time space, will companies have to go bust?
Again, on a short-term basis, the interest rates are still negative, if I may, and we are still in a universe which is a universe of accommodation. At least, certainly on both sides of the Atlantic. Now, I would also note, if you permit me, that on both sides of the Atlantic, the goal is to, I would say, anchor inflation expectations at around 2%. And that is very important because all central banks of the major advanced economies, those central banks that are issuing the currency that are in the basket of the SDR have the same definition of price stability, the same goal, 2%. It was decided upon after Lehman Brothers crisis. And it is, in my opinion, the most important de facto reform of the international monetary system since the Bretton Woods explosion. I insist on that, I stress that. 2% in Japan, 2% in the US, 2% in the ECB, and 2% in London.
Should that go up? Should we change the inflation target because of what we're living through?
I would guard all of us against that. At times, I had some academics claiming that 4% would be much better than 2%. Then you had academics and observers saying 0% would be much better, or 1% would be much better. I am fully encouraged by the fact that all central banks, and not only on both sides of the Atlantic, have reaffirmed very clearly that their anchoring of inflation expectations was 2%. It seems to me that in a world which is extremely turbulent, extremely dangerous, full of uncertainties, the fact that the central banks appear as solid anchor of expectations, which they did in Lehman Brothers and after Lehman Brothers, which they did even in this dramatic period of inflationary absence, total inflation absence, and I would say materialization of the deflation being very present, they maintain the 2%. And now, again, they maintain the 2%. I think they are right, and they are unanimous to do that.
Monsieur Trichet, talk to me a little bit about currency. So we saw some pretty wild swings for euro. What do these current currency dynamics with euro and dollar tell us about the state of the world?
I'm sorry, because I'm not sure I heard the question totally. You are speaking of currency. Is it the exchange?
Yeah. No? Yeah, the exchange between how should the central bank worry and look at euro?
Oh, yeah. Well, again, as you know, and as is repeated by François Villerat-Gallo, by all central banks, governor, by Christine Lagarde, they have no objective as regards exchange rate. And I had no objective in my time. Mario Draghi had no objective in his time. Still, of course, you have to take all parameters when you take a decision. And it's clear that if your currency is very low, you are importing inflation, whether you like it or not. And the reverse, of course, when you are in the opposite position. So I would say, of course, we are not at all at the very low level that we had at times in the euro-dollar relationship. There has been a lot of fluctuation from 0.83 at a time. And I had experienced myself that when I was member of the governing council of the ECB, up to 1.55 or something. So big variation. So I will not dramatize the present relationship between the euro and the dollar, but of course, it is taken into account by the governing council when they take their decision, because it's part of the overall parameters that are essential for judging what is likely to be inflation, all taken into account. But again, there is no, in my understanding, no goal.
Monsieur Trichet, we also heard, of course, we have a new prime minister here in the UK, Liz Truss. She was very controversial about central bank independence, that we should no longer go on as business as usual for the Bank of England. Your thoughts?
I think that the central bank independence is absolutely key. Again, in a world which is full of extremely hectic potential behavior, full of risks, full of uncertainties, to have an institution which can be the anchor of stability, the anchor of expectation, is decisive. And so it is essential, in my opinion, that the new UK government joins the consensus that we observe on this side of the Atlantic, on the other side of the Atlantic, and has been reaffirmed, if I may, during the last meeting between President Biden and Jay Powell. So we have something which is strong, which is solid, which is experienced since quite a lot of period of time. And again, it seems to me that the UK, I am confident that the UK executive branch will join in.
Thank you so much, Mr. Jean-Claude Trichet, there, the former ECB president. A pleasure, as always, to have your thoughts, of course, on monetary policy and inflation. Coming up, the merge crypto markets are braced for an upgrade for the history books. We'll look at the context. This is Bloomberg.
of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
Now we're showing you live pictures from Westminster Hall, I think, where Britain's Queen Elizabeth II is lying in state. We've been covering, of course, as people and thousands of people actually queue to pay their respects to the monarch. We'll keep a very close eye on that. We also keep a close eye on the markets. The markets overall pretty much steady after the 2 difficult days that we had. Also, crypto's most important commercial highway, Ethereum, just got revamped. According to its co-founder, Vitalik Buterin, the blockchain network has now completed the crypto's most ambitious change to date. Well, we're now joined by James Butterfield, head of research at CoinShares. James, great to speak to you, because I think last time you were in a banking job, right? And then now you're kind of like crypto. How excited are you about this change and the fact that they're becoming greener?
This is massive. I mean, Ethereum has been trying to shift to a proof-of-stake protocol for many years. What's very important for cryptocurrencies is that they have a large network, and a proof of work where they mine is a good way. It provides an economic incentive to build a network. Now it's done that, and it's shifting to this proof of stake where it stops mining. It will offer now a 5% yield. So far with the merge, which happened at 7:40 this morning, everything looks to be progressing well.
Yeah, I love the fact that we call it the merge. It's suddenly like that, you know, you've taken over, they've taken over this term that we used to use all the time. So what are the proof of systems for? Is there an understanding, like how much percentage-wise of the population actually understand what this means? And if you think it's a small percentage, can you explain it to everyone?
Yeah, the proof of systems is a large decentralized network, and you need people to validate it and then have an incentive to validate it. It's easy and simple in a proof of work where you mine. In a proof of stake concept, it's a lot harder. So the idea is you issue a yield, you print more Ethereum essentially to issue a yield. But what's very interesting about this, it's been very technically complex, is on the flip side, they are burning an element of yield. So it will be the first cryptocurrency where you see a net issuance of either neutral or slightly negative. So it's a deflationary cryptocurrency.
But so, I mean, there are pros and cons. So what is the number one drawback to this?
The main problem, I think, is political or regulatory interference. With Bitcoin, there is no leader to subpoena. But here we have, with Ethereum, we have the Ethereum Foundation, and they can be subpoenaed, and that could influence it. But it's unlikely. It looks like now, where they're much more environmentally friendly, they will reduce world energy costs by 0.2%. So it looks like there'll be a much more politically friendly opinion towards.
Does it make it more vulnerable, or what are some of the vulnerabilities, though?
Yeah, some of the vulnerabilities are that there could be some sort of political attack. It's less decentralized, so theoretically you could see a much larger stakeholder, a 51% attack, so to speak. At the moment, though, we're seeing there's 420,000 validators on Ethereum proof of stake, so it seems highly unlikely that will occur.
Just so we understand, I mean, there's not, the user experience doesn't really change because of this.
That's absolutely right. I mean, we've not really seen the price flinch since it's happened, and a lot of investment products that are associated with ours, there'll be no real change to those.
So what will this mean for proof of work blockchain?
There
if
is
it's successful.
Yeah. Well, this is i.e. Bitcoin. This is proof of stake, but proof of work blockchain. So there is potentially an offshoot here.
Yeah.
Proof of work. So some miners could carry on mining a different chain. They fork off. Appetite looks very low for it at the moment. There are only 2 developers running this new network. So I don't think it's really going to go anywhere. But a few people are pontificating about it.
I mean, what does it mean for Bitcoin? This is something that we keep on getting asked.
Yeah, I mean, people talk about the flippening where people start to see that Ethereum's much more attractive. I think they're 2 very different assets, and the market is starting to realize that. Ethereum is a bit like Amazon Web Services, but with a currency rolled into it, whereas Bitcoin is much more some sort of money. It's a stateless asset, more of a store of value in that respect.
Yeah, so you don't see it merge. I mean, you don't see a move from one to the other just because also we cover it so much?
No, I mean, when we see inflows into our investment products, we tend to see them rise, inflows in tandem. So investors aren't necessarily saying, oh, it's one or the other.
James, who does your research go to? So I find it fascinating that we have seen a move of at least interest or appetite to understanding from maybe some of the big investors, but unclear to me if they then use it in practical terms.
Yeah, so I say our main audience is institutional investors now. And a lot of our role, I think, is education, helping people understand crypto assets, the difference between them, the concepts behind them. It's a big learning curve for many investors. You know, don't forget, this is a brand new asset class. It's only been around 13 years. We're witnessing the birth of a new asset class. How often do you see that in your investment career? And this is so fascinating for us.
Thank you so much, James Butterfield there, Head of Research at CoinShares, with some very good, important, but also simple analysis. Much needed, James, and thank you so much for coming on. Coming up, we'll continue to cover the day's events in the coming hours, including, of course, the UK's period of mourning, where currently the Queen is lying in state as thousands and thousands queue to pay their respects. More to come on this. This is Bloomberg.
Cryptocurrencies have been very popular. And if a client came to you and said, look, I'd like some cryptocurrencies in my portfolio, what would you say?
Oh, we've actually been really deep into crypto, deep into learning about blockchain, and all of the new businesses. You know, I would characterize us as crypto learners. You know, we have made a series of toehold investments on behalf of our clients, both in some of the currency baskets as well as with some venture firms that are investing primarily in the crypto area. I think it has the potential to be completely game-changing, but it is still such the Wild West, and it's so uncertain. But it has the potential to completely upend everything.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The UK is considering scrapping a cap on banker bonuses, a controversial move that underlines the new government's determination to introduce major post-Brexit reforms. The financial services. The new Chancellor, Kwasi Kwarteng, is said to believe the change would make the City of London even more attractive. The cap was introduced by the EU in the wake of the 2008 financial crisis. Now in the US, talks aimed at averting a US rail system shutdown have continued into the early morning. About 125,000 workers could strike if there is no agreement tomorrow. US Labour Secretary Marty Walsh is leading the negotiations between unions and freight rail companies. Amtrak says all long-distance trains are currently cancelled. The Chinese megacity of Chengdu is allowing most residents to leave their homes, largely dismantling a 2-week lockdown as COVID cases do decline. People who have tested negative in the previous 24 hours will be allowed to return to work, while transport hubs and supermarkets will reopen. South Korea's top trade negotiator says Seoul and the US are stepping up efforts to resolve a dispute over electric vehicle subsidies as they seek a closer supply chain cooperation. In an exclusive interview, Trade Minister Ann Dugan told Bloomberg the two sides will begin talks tomorrow.
Fortunately, the U.S. government sincerely engaged with us to solve this problem. I agreed with the Ambassador Tai in the USTR to establish bilateral engagement channel, and the working level discussion will start actually this Friday.
And the founder of clothing company Patagonia is giving away the company. The entrepreneur has transferred the ownership valued at about $3 billion to a specially designed trust and non-profit organization. The report says all of the company's profits will now be used to fight climate change and also boost conservation. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Katie Lyons are in New York. Anna Edwards here in London, and this is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better.
And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Grand scheme of things, the Fed strategy and the domestic inflation story here dominates.
Companies and industry, they want long-term contracts. We're in an environment shaped by supply constraints.
Supply challenges are only going to get worse if we're not able to quickly and efficiently move product across the United States from our plants and also from our ports.
This is Bloomberg Surveillance, Early Edition with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The clock's ticking. Negotiations to avert a nationwide rail strike in the U.S. continued overnight. The deadline is approaching. Which billionaire do you believe? Ray Dalio says that interest rates at 4.5% could cause stocks to plummet. But David Rubenstein says it's a good time for investors to jump back into equities. And crypto's most important highway just got a major upgrade. We will tell you what changes to Ethereum mean for investors. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, we have to focus on railroads and logistics concerns leading into energy concerns when it comes to the United States today. Also focused on U.S. data.
Yeah, it's just another potential supply chain headache, Anna, and it could wreak havoc on the U.S. economy. So we're going to have an update on that in just a moment. Let's first, though, get an update on the markets. It was a mixed day in Asia overall. You had stocks higher in Japan and Hong Kong, but down in China. All of that adding up to an MSCI Asia Pacific index lower by about 0.25% on the day. And I said stocks broadly were down in China, but there was one group that actually outperformed. An index of developers in China rallying about 3 percentage points on reports of a ramped up effort on the part of officials to halt the slump in the housing market. And of course, Chinese officials also would like to halt the slump in the Chinese yuan. You had draining of liquidity from the banking system for a second month announced overnight. They also left rates on hold, trying to lend some support for the currency. And yet the dollar strengthening against the yuan once again today. We are very, very close to that closely watched 7-figure. Right now it's 698.69. And all this talk of verbal intervention or maybe outright intervention in the Japanese yen also not giving a lift to that currency. The yen, too, weaker against the dollar this morning, trading at 143.44, Matt.
All right, in terms of U.S. futures, Kaylee, we're looking at not a lot of movement here today. Really unchanged after we didn't get much movement by the close of trading yesterday either. So after that big plunge that we saw on Tuesday, markets have been really in a holding pattern. The same is true for the 10-year yield, still at 345, 344.51 right now. So it's coming up about 4 basis points, but it's still holding in the same range that we saw it jump up to on Tuesday after that inflation print. NYMEX crude right now at 88.68 a barrel, so also only moving about 18 cents, 21 cents a barrel this morning. And Bitcoin also stuck at $20,000 even after the merge. News that the merge was completed. Of course, that affects Ether, but directly, but indirectly, it affects all of the crypto currencies. And you haven't seen much reaction at all in terms of really Ether or Bitcoin this morning. Anna, what do you see in terms of Europe?
Yeah, that seemed to go smoothly. We'll get further analysis on the crypto front later, won't we, Matt? In Europe, then, we are, as you said, in limbo, really, in terms of risk appetite. So stocks in Europe, either side of the flat line, a bit of weakness coming through in Paris and in Copenhagen. But the Spanish market doing pretty well. The UK market up by around 0.5%. If we have a look at what's driving that, the banking sector doing pretty well. And so as we see yields going higher, and I've got the French 5-year yield to illustrate that, but I could have illustrated it with lots of other bond market products. And the move's not dramatic this morning, but it's the sort of, it's part of a theme, isn't it? As those yields are going higher, we are seeing the banking sector respond, up by 1.7% for banking stocks here in Europe today, especially the Spanish banks. They seem to be doing pretty well. Shell also on the rise, the energy company up by 0.5%. Ben van Beurden, we've had it confirmed today, is going to be leaving the business. He's been there for decades, of course. Most latterly a CEO. He helped to build up the gas business at that company, and it is the head of the gas unit that is going to be taking over, and that's not being seen as much of a surprise by the analysts who follow the company. Talking of gas, this is the natural gas price here in Europe, up by 7.4%. So we were below 200 euros a megawatt hour for some time, now ticking back up towards the low 230s or into the low to mid 230s. Is there some doubt creeping in about what Europe can achieve here? They've put on the sidelines that talk of a cap on gas prices. They are doing other things, trying to drive down demand. Whether we can get agreement across Europe is a key question, of course, Kaylee, as we head towards the winter.
Absolutely, and we're going to have more on the EU's energy crisis through the lens of Italy as well later on this program. As for what's ahead later on today, Chinese President Xi Jinping and Russian President Vladimir Putin will be holding their first in-person meeting since Russia invaded Ukraine. And U.S. Treasury Secretary Janet Yellen will deliver remarks from Maryland to talk tax code changes from the Inflation Reduction Act. And finally, we'll get some more economic data, U.S. retail sales crossing the wire at 8:30 a.m. New York time, Matt.
All right, definitely paying attention to that. But the most important economic data is going to come out of talks aimed at averting a U.S. rail system shutdown. They continued early into this morning. No word if there's been any progress yet. About 125,000 workers could strike Friday if there's no agreement. And if they do, that will jam up goods across the country after we've already had such a horrible supply chain hit. Bloomberg's Kriti Gupta joins us now from Jersey City near Greenville Yard to unpack the details of this issue. So what do we know about the talks, Kriti?
So what we don't know is really where the developments are. We know, of course, that the core of the issue is not even wage increases. At the core of the issue, it's really access to sick leave, medical leave. Matt, this is really a legacy of the pandemic here. The railroad workers are the backbone of the American economy to some extent. 30% of the entire country's cargo goes through rail, goes through freight. So naturally, they are working long hours, 12-hour days. But during the pandemic, what ended up happening was so many people left the workforce that they had to create a new system that meant you are now on call 90 minutes to 2 hours with 2 hours notice of advance notice, I should say. And then if you don't make it, you are starting to be deducted. You're getting penalized even for things like sick leave, even like for things like anticipated events that you need to take time off for. And that's really what's at the heart of the issue. The labor negotiations, well, they're talking about a 24% increase. They're talking about back pay. But at the end of the day, that's really not what these workers are most concerned about.
Well, Kriti, on the subject of those negotiations, we just had a breaking headline crossing the Bloomberg terminal. The U.S. Department of Labor saying that the rail companies and union have come to a tentative pact. I guess the operating word there is tentative. So we'll see if that holds, what the details of that look like, if it ultimately will get approved by the labor side of things. Can you just talk to us about the industries in the line of fire here that could be most effective should an ultimate pact not actually come through?
Yeah, and the headline there, Kaylee, is really crucial, and simply that there is historical precedent for this, that there have been tentative labor agreements, but at the end of the day, Congress has historically had to impose those agreements on unions that tend to walk away. When it comes to the industries, Kaylee, it goes from autos to retail. Think about it, all the new vehicles, all the auto parts, they are indeed transported through freight. It's the most efficient way. Think about it from Mexico. Think about oil coming from Canada, refined products, ethanol going to refineries. All of that is going to be put on hold, including commuting. We know from yesterday that Amtrak has canceled their long-distance rail service, but it also comes to closer commuting, domestic commuting. Chicago, the rail system, already warning that they might not actually be able to have their local railway system, Metra, actually in full service. Same with Minneapolis, San Francisco. This is becoming a nationwide issue that could literally put the entire economy on halt.
All right, Bloomberg's Kriti Gupta reporting from the field. She will be there in Jersey City near Greenfield Yard throughout the day, so look for her updates. Let's get the view from Washington now. Jack Fitzpatrick, Bloomberg government reporter, is joining us now from D.C. So, Jack, just to reiterate the breaking news we just received, the Department of Labor saying that the rail companies and union have reached a tentative agreement. How difficult have these negotiations been on the side of the Biden administration?
Pretty difficult. It's a high-profile decision to have the Labor Secretary, Marty Walsh, play a key role to try to get an agreement. And it shows that it was difficult, especially following up with the Labor Secretary after the President's Emergency Board's recommendations did not seem to move things forward. There was a question yesterday as to whether Congress would and had the willpower to require both sides to agree to the outline from the President's Emergency Board. It did not look like there was support for that. There were a couple Senate Republicans who tried to bring that measure up on the Senate floor, and it was blocked by Bernie Sanders. So there were very fundamental questions about how exactly this was going to move forward. Marty Walsh clearly has taken a prime role in moving that ahead. If this tentative deal sticks, then that's a huge sign. But it was something that clearly the administration was struggling with right up until this deadline coming up tonight.
Jack, let's pivot to something that is developing on the geopolitical front more than 6,000 miles away from Washington. The leaders of Russia and China meet today in Uzbekistan for the first time since the invasion of Ukraine. Shortly before the attack in February, Vladimir Putin and Xi Jinping declared, of course, no limits to their friendship. Still, after suffering humiliating losses on the battlefield, President Putin shouldn't expect much help from Xi, we understand. China has resisted sending military supplies or financial support. Jack, how might President Biden view this meeting? Very symbolic, but with reduced expectations about what support will come from one to the other.
Yeah, the Biden administration has tried to keep key players like China away from a formal role in helping Russia. They've been sort of verbally supportive at times of Russia's invasion of Ukraine, but the key question from the Biden administration is, would there be military aid? Would there be more significant economic aid from China to Russia? It does seem to be something that will come up at this meeting. A Putin aide has told the TASS news agency in Russia that they expect both Ukraine and Taiwan to be discussed in the meeting. So it's not something they're going to ignore. But again, the Biden administration and really on a bipartisan basis in the U.S., there's the hope that China would not take any concrete steps forward that would provide significant aid to Russia.
All right, Jack, thanks so much for joining us. Jack Fitzpatrick there, Bloomberg Government, talking to us about the breaking news on the agreement reached for rail workers, as well as the meeting between Putin and Xi. Now let's get to crypto. The most important commercial highway, Ethereum, just got repaved, so to speak. The blockchain network completed the crypto world's biggest and most ambitious software upgrade to date. It's known as the merge. You've probably heard about it a lot, and you very likely have no idea what it means. Well, it doesn't matter. It should make things more less energy intensive and greener. Shonali Bassick, our global finance correspondent, joins us now for more. So we've got the merge completed. What's the next step?
I think a lot of confusion here is that the merge is just one step in a series of software upgrades for Ethereum. So the idea here that this would immediately improve transactions and improve gas fees, which is really those transaction costs, that doesn't really come at scale until later on in the upgrades, which come in 2023 and even 2024, assuming that those also go correctly. But it is a really pivotal moment. This was the biggest software upgrade seen in the space, and it moves over to a system that is less reliant on those miners to validate transactions and more reliant on that proof of stake that everyone is talking about, the way to validate transactions through a community putting more of their ether at stake. It changes the economics of the system. You have Vitalik Buterin, a co-founder, really taking to Twitter to really explain what's going on and show the effects of it. And he is saying that there is some performance that is being improved improved on the network, particularly that can move towards ultimate goals of improving gas fees and that ultimate goal for Ethereum, which is making it more scalable, making it more secure, and making it more...
Gas fees. Anna, gas fees will be improved. Aren't you relieved?
Excellent. Well, happy merge to all, so says the Ethereum co-founder. So, happy merge if you're celebrating. We've dealt with what happens in the sort of short term then, Shanali. And as Matt was saying earlier, the market seems to be taking it quite smoothly, which no doubt will be well received by those involved. But what are longer term concerns surrounding this switch?
It's a great question, and I think you see some muted reaction today because today is not over. We know that the merge has happened, but one of the big concerns around the merge is potential scammers, people creating essentially forks or things that look like the Ethereum new network, if you will, that will attract customers to their own Ethereum fork. So that is one big concern today. You also have a lot of concerns in the longer term because staking is something that regulators are taking a look at. So you have exchanges like Coinbase getting into it, but other exchanges, FTX, for example, that hasn't really taken this on as a business. So if staking doesn't become a bigger business among the exchanges and other companies that really are the highway to getting more customers into crypto, then there's a lot of questions around how much staking can be done, how much can it be done at scale, and how much can it really improve the access to more people in this community? Is staking another yield product like we've seen in so many other crypto products that have gotten into trouble or that require more regulatory oversight? It's a huge open question, Anna, and it's something that until there's more clarity can really be a question around the system.
All right, our merge correspondent, Bloomberg Shanali Bosick, thank you so much. And we'll have more on the merge later this hour with Justin Drake, researcher at Ethereum. And of course, make sure to tune into Bloomberg Crypto every Tuesday at 1 p.m. New York time. We cannot talk about this stuff enough. I do want to talk, though, about the breaking news we received just moments ago. The U.S. Department of Labor saying that rail companies and unions have reached a tentative agreement. President Biden releasing a statement a few moments ago saying that the tentative agreement reached is a win for tens of thousands of rail workers who will get better pay, improved working conditions, peace of mind around healthcare costs. He also calls it a victory for railway companies. And he says for the American people, the hard work done to reach this agreement means that our economy can avert the significant damage any shutdown would have brought. So again, a tentative pact reached between rail companies and the union. We'll continue to update you on this breaking news. But we also want to update you on some stocks moving in pre-market trading here in the U.S. I want to begin with Danaher, the big conglomerate. It announced yesterday that it's going to spin off its unit that does things like test water quality and also package design, really trying to narrow its focus to science and health. Investors seem to like it with the stock up about 4.4%. Another stock moving higher is Netflix. Now, it was also higher yesterday after a Wall Street Journal report that the company is projecting 40 million subscribers on its ad-supported streaming service by the third quarter of 2023. But then you also had an upgrade for the stock over at Evercore, so that giving another lift to it this morning, up about 2%. One stock moving to the downside, though, is NextEra Energy. This is after it announced after the bell yesterday an offering of about $2 billion worth of stock and debt units. So that stock down about 3.6% before the bell, Anna.
Coming up on the program then, Kaylee, we will talk to Anika Gupta, Research Director at Wisdom Tree. What does she make of strike activity in Western economies and how disruptive is that going to be? We'll also get her investment outlook. And a Chinese spy tried to steal GE's secrets. Instead, he got caught by the US and gave the world an unprecedented glimpse into China's espionage apparatus. You can read all about it at Bloomberg.com or by typing NI Big Take into your Bloomberg terminal. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus
after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center. The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards with us out of London. Now, Ray Dalio came out with a gloomy prediction for stocks and the economy as well after hotter than expected inflation that we saw on Tuesday. He said, quote, "It looks like interest rates will have to rise a lot. This will bring private sector credit growth down, which will bring private sector spending and hence the economy down with it." He thinks that stocks are going to fall 20% if rates rise to his prediction, the high end of 4.5% to 6% range. On the other hand, Carlyle founder David Rubenstein said it's a good time for investors to jump back into stocks. He said, quote, "When markets are in trouble, as they are now, you could argue now is probably a pretty good time to invest." Joining us to give us her take is Anika Gupta, Wisdom Tree Research Director. So you've got two big, brilliant minds on opposite sides of the trade here, Anika. Do we have further room to go in terms of the downturn in stocks, or is now the time to be buying?
Morning, Matt. Well, it really depends on the time horizon that you have for your investment profile. If you're looking long term, then yes, I would agree with Ray Dalio. But if you're looking for a medium to short term trade, then I think you need to be a lot more cautious because there's a lot of uncertainty lingering around in the horizon.
So just to be clear, Dalio says stocks will fall 20% more from here. You think that that makes sense?
Well, I think we definitely have further downside. I wouldn't say it would be as sharp as 20%. Given the fact that we have each of the economies globally going through very different circumstances and very different economic narratives in each of these economies. So I think on the whole, we are in for further downside given the uncertainty into year end, but I wouldn't say that it would be as sharp as 20%.
Anika, good to see you. So it seems the market is leaning towards expecting 75 basis points of hikes from the Fed this time around, rather than 100, although 100, as we said yesterday, remains a point of discussion. What would it mean to markets, do you think, if we saw a hike of 100 basis points, a whole percentage point?
Morning, Anna. You're right. 100 basis points is still on the table. Given the recent CPI report that we've seen, it did come as quite a surprise, given that there was a broad-based increase across all measures. But the reality is, over the long term, that the direction for CPI is showing signs of peaking. And given that narrative, we do expect the Fed to remain on a hawkish cycle, but we don't expect a rate hike as aggressive as 100 basis points. I think the important thing to keep in mind is, sure, a 100 basis point rate hike would definitely be a big shock to the market. But the important thing to keep in mind, and that's something that everyone is aware of, is that we do need to see the neutral rate come up to the 4% level, and that would be staged across the next 3 meetings that we see. So I don't think the Fed is going to go and push the market in that one direction and shock the market.
Well, Anika, you talked about the upside surprise on CPI, but we also got PPI data yesterday, which is what ultimately matters to companies in terms of margin. How are you thinking about inflation as it relates to that earnings story?
Well, Kaylee, you brought up a very good point. We are going to see company profits and margins being squeezed by the higher inflationary impact. On one angle, you also have the stronger dollar in the U.S., which is going to squeeze margins, given its global footprint. And at the same time, you're seeing demand beginning to wane. Today, we have the important U.S. retail sales print. And again, there we're likely to see a slight decline take place, which is pretty much on the back of that constraint being seen by the 10.6 plunge in gasoline prices. So I think overall, our view is that we are likely to see margins decline. Earnings revisions ratio in the U.S. is still fairly stable when you compare that to Europe, China, emerging markets, which are showing a decline. Japan is still holding up pretty well.
Yeah.
So I think it's these two economies that are providing a greater margin of safety compared to the other economies globally.
All right, Anika Gupta, Wisdom Tree Research Director, thank you so much for joining us. Now, keeping you up to date with news from around the world, here's the first word. Back to that breaking news, a potentially crippling nationwide railroad strike in the U.S. has been averted. The Labor Department says that rail companies and union negotiators have reached a tentative agreement that, quote, balances needs of workers, businesses, and the nation's economy. About 125,000 rail workers had threatened to go on strike on Friday. There are fewer options for Russia's President Vladimir Putin in Ukraine after humiliating setbacks on the battlefield. Russia is plagued by a shortage of troops, low morale, and what the U.S. calls a shift in momentum. Still, the Kremlin appears determined to keep escalating the fight, stepping up strikes on Ukraine's infrastructure deep behind the lines. The British government may do away with a cap on banker bonuses. It's a controversial move that underlines the new government's determination to introduce major post-Brexit reforms in the City of London. The EU imposed the cap after the 2008 financial crisis. It limits bankers' bonuses to 2 times their salary. And Bloomberg Business Week is out with its annual ranking of the world's best business schools. Once again, Stanford tops the list in the U.S. Chicago and Harvard tied for second place, followed by Northwestern and Dartmouth. In Europe, IMD is number 1, followed by INSEAD, IESE Business School, London Business School, and SDA Bocconi. And Matt, we always love getting those rankings. I always look for Darden at the University of Virginia first. That came in at number 9 this year.
Yeah, absolutely. I think a lot of people pay very close attention to this, especially analysts on the street finishing up a 2-year program looking to get back into school. And it's really an important story for Business Week, and I recommend all of our viewers and listeners go straight to Bloomberg.com and check out that Business Week story.
We certainly will get more perspective there. Also, fascinating story that Kaylee just went through about the UK government considering removing the cap on banker bonuses.
Yeah,
just
that's
as we're
huge.
Talking about times getting a little bit tougher for bankers in terms of those bonuses. So maybe the cap wouldn't have been maybe needed anyway. But I wonder also how that goes down with the new voters for the Conservative Party who were brought on board by Boris Johnson, who previously voted Labour, more left-leaning. What would they make of this post-Brexit freedom being expressed by the UK government? Right, more on that, no doubt, another time. Coming up on the programme, Europe introduces a raft of changes to tackle its energy crisis. We will talk to the Italian Minister, Elena Bonetti. She'll weigh in on that crisis. Also talk to us about population and family matters around Europe, a big talking point heading into the Italian election. This is Bloomberg.
the standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, you ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe to 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Mitch and Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The clock's ticking. Negotiations to avert a nationwide rail strike in the United States continued overnight. The deadline is approaching. A tentative deal appears to have been reached. Which billionaire do you believe? Ray Dalio says that interest rates at 4.5% would cause stocks to plummet. But David Rubenstein says it's a good time for investors to jump back into equities. And crypto's most important highway just got a major upgrade. We'll tell you what changes to Ethereum mean for investors. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. And Matt, after the excitement, in a negative sense, if you're along of stocks, of Tuesday, things look much calmer today. Got data out the US later on, of course.
Yeah, well, and I'm actually surprised that we're not seeing futures move a heck of a lot higher after that rail agreement was reached, because a strike would have been a really serious problem for the U.S. economy, a really serious problem for U.S. companies, and probably a serious problem for the stock market. Nonetheless, futures are just stuck at unch right now, so we're looking at just less than 1/10 of a 1% gain, now a little bit more. We do see investors willing to let go of the perceived safety of treasuries. Now you can see 3.5 basis points gain on the yield, but that as well is kind of stuck in a range that we saw set on Tuesday at 344. NYMEX crude also unchanged at 88.39. So really markets are doing very little, even when you look at crypto, notoriously volatile. Really no movement after the merge. And frankly, there wasn't much movement before the merge either. We see Bitcoin just holding at a $20,000 level and Ether holding at about $1,600. So it looks like investors are waiting for something to decide whether to go with Dalio's call of 20% further downside or Rubenstein's call of now is the time to be buying stocks. Kaylee, what do you see in the pre-market?
Well, kind of what you're seeing at the higher level, which is that there's not that much going on. I was staring at my most function on the Bloomberg terminal today, like, give me something, because there really just isn't a lot of movement for individual equities. I did want to point out one that is related to that move in crypto. Coinbase, the big crypto exchange, is up about 1%. And as for the biggest movers I could really find this morning, at least in the larger cap space, they're only up about 2%. One of those being Netflix, which was also higher yesterday on a Wall Street Journal report that it's expecting 40 million subscribers for its ad-supported streaming service by the third quarter of 2023. It also received an upgrade at Evercore today, so that lifting the stock. And then you also have Wynn Resorts and Yum China higher. This is likely a China reopening story. Of course, Wynn Resorts exposed to Macau in particular, very dependent on it for revenue. So as you're seeing COVID restrictive measures being eased in places like Chengdu, that is giving a lift to those stocks, up about 2.2 and 2.8% respectively. So not massive moves, Anna, but still something to note.
Yeah, and not massive moves here in Europe either, Kaylee. We've got European stocks just up by 0.2%. The banking sector doing much better than that, though, up by 1.7%. Higher interest rates seem to be playing out well there. We've got the French 5-year yield, an illustrator of that, so a bit more of a sell-off in those bond markets and yields going higher. We've seen it certainly at the short end of the US curve, a lot of focus on inversion, twos versus seemingly lots of other tenors on the Treasury curve. So a lot of conversation around inversion, and we see the banking sector at the moment, stocks in the banking sector moving higher. Shell is of interest on stock specifics, up by around 0.5% today. The energy business losing its CEO, Ben van Beurden, after many decades, Matt, at that business. And we've talked to him many times through all kinds of crises and the building up of Shell with the purchase of BG Group that really expanded the gas portfolio of this business. We talked to him many times over the years. He is stepping away, leaving the company with the person who used to run the gas section of the business, which apparently, according to analysts, seems to make sense.
Yeah, having driven Shell's business much more towards a zero emissions operation. At least they want to go that direction and continue until they hit that goal at 2050. Speaking of hitting a goal, one has been achieved in crypto. It's the most important switch that we've seen for any major cryptocurrency. Ethereum completed the merge, a software upgrade. The blockchain network completed crypto's biggest and most ambitious software upgrade to date. We spoke with Ethereum co-founder Joseph Lubin earlier this week.
We think it'll be enormously impactful, but it'll also be very likely nothing, in the sense that there's no disruption that's going to be experienced by end users. There's virtually no disruption that's being experienced by software developers. It'll be as smooth as if your iPhone or your laptop has upgraded its operating system automatically overnight.
Joseph Lubin there, co-founder of Ethereum, speaking with Bloomberg on Tuesday. Now, it is really the most important commercial cryptocurrency because of the many different use cases, not just a store of value like the original Bitcoin. Justin Drake joins us right now, researcher at Ethereum, to explain the merge. I mean, Justin, if you could explain what's happened, the shift from proof of work to proof of stake to someone to whom those phrases mean nothing, which is, I guess, most people in the world. Very simply, how would you put it?
Right, so Ethereum is a settlement layer for the Internet of Value. And the way that the security works is through what's called a consensus engine. And what we've done today is we've upgraded the engine. We've done a massive upgrade. And you can think of it like upgrading the engine of a car. We've gone from gasoline to electric, and the properties of this new engine are really, really outstanding relative to the previous engine. And we've done this switch of engine while the car was running, and it all went smoothly.
So the price action, which is virtually none, right? We're unchanged on Ether right now at 1592. Bitcoin, just as you know, a mile marker in terms of crypto, unchanged at 20,000 right now. Does that mean you've succeeded? You haven't caused any ripples in the system?
That's correct. It looks like the market was expecting success, and indeed we did deliver with success. One of the key features of this upgrade to the consensus engine is the dramatic reduction in so-called issuance. So we're going to have 10 times less ETH that is produced every single block, every single second. And so what that means is that there's going to be roughly $20 million less of sell pressure every single day. So even though we're not seeing any price action today, it's not like someone would come in and buy billions of dollars in one go. No, instead is sell pressure, which is being reduced by roughly $20 million per day.
Justin, you've said, I think, in the past that with what's happening with Ethereum right now, it's becoming a settlement layer of the internet, a low-level piece of infrastructure, which makes it sound very important, but not very exciting. Why is today so exciting?
It's exciting because you can build applications that are robust, that will live for decades and centuries, applications that can be trustlessly composed with each other. If you think, for example, of applications like Uber and Lyft and Airbnb, these are silos. their competitive dynamics means that they don't compose well with each other. Imagine a world where, just like the early philosophy of the internet, everything's open, everything's composable with each other. And so what I expect is kind of this exponential innovation from this permissionless open innovation.
Well, just on the subject of innovation, or at least what upgrades could come moving forward, Justin, obviously, now that the merge is complete, you will likely immediately see the reduction in energy use. I believe Vitalik was quoting you on Twitter today that it will reduce worldwide electricity consumption by 0.2%, which is not insignificant considering this is just Ethereum that we're talking about. Yet there's also maybe the ability in the future for transaction times to be materially reduced, for this to become more scalable. How long is it going to be before we get the requisite upgrades to reach that level?
Right. So Ethereum today, as a settlement layer, only processes 10 transactions a second. That's the order of magnitude, which is definitely not enough to settle the whole Internet of Value. We need to get to 10 million transactions per second. The good news is that we have 3 100x improvements that are coming. The first one is what's called rollups. Is this idea that you only put data on chain, not the execution. And that's going to give us 100x. There's projects like Optimism and Arbitrum, and you may have heard of ZK rollups and optimistic rollups. Anyway, the next big 100x is called sharding. Is this idea that as a consensus participant, I only have to do a fraction of the work. I only need to download a fraction of the data in order to provide the full security to Ethereum. And then the final 100x is this effectively Moore's law for bandwidth. Every single year, bandwidth increases roughly 50%, and we can leverage that over 10 years, compounding, to get another 100x in total bandwidth. And so the end game is 10 million transactions per second, which is enough for every single human on Earth to do 100 Ethereum transactions per day.
Yeah, I would definitely call that scale, Justin. Just final question, how worried are you about the risk of power concentration in a staking model?
Right. So one of the amazing properties of staking is that the barrier to entry is much, much, much lower than proof of work. You can come in with even just 1 Ether and join a pool and start profitably staking. The other amazing property is called fairness, which is that for every single unit of stake that you put forward, you have a fixed APR, regardless of how large you are. So if you're staking 1 million ETH or you're staking just 1 ETH, you still get the same APR. And this is dramatically different to proof of work, where there's these economies of scale, which means that only the very, very large players can be competitive. And that leads to centralization, which is not something that we have with proof of stake.
Justin, thanks so much for joining us. Justin Drake there, a researcher at Ethereum, talking to us about the merge. Tune in, by the way, to Bloomberg Crypto every Tuesday at 1 p.m. New York time. That's our weekly show. It covers the people, transactions, and technology shaping the world of decentralized finance. That's where we heard from Joseph Lubin this week. This is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, of the US, Europe and the UK, have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. Let's talk about the European energy situation. The European Commission has proposed to member states a raft of regulatory changes to alleviate the liquidity squeeze in the energy sector. This as the continent ramps up support to industries and consumers affected by Russia's throttling of gas supplies. Let's get to Bloomberg's Maria Tadeo. She spoke to Kadri Simpson, EU Energy Commissioner, yesterday.
The design of this package is extraordinary. So this is an emergency intervention package, temporary package, but we use like special article in our treaty. And that means that member states will be able to find agreement very fast. I truly hope, and I saw a willingness among our ministers that they will support the measures that we propose today. And that actually helps them to support their consumers and also to avoid situations where we will have blackouts or will need for curtailment.
Let's talk more about this issue right now with Maria Tadeo, our European correspondent. She joins us from Paris. Maria?
Well, Matt, what an interview. I think to me the key takeaway now overall when you look at the situation in Europe is that this is a continent that is prepping itself for a war economy. When you talk about demand that needs to go down, you talk about binding targets, you talk about a solidarity contribution, which is essentially a tax, and you say sanctions are not going to be changed because we have to help Ukraine, and you take a political stance on that. To me, this is a war that is now, or essentially an economy that's heading into something that looks like a war machine, a war economy. Whether it succeeds, I think a lot of this will depend on the member states, which is why I'm so interested to see where your next guest, the Italian minister, will tell you, because Italy is a key country exposed to Russian gas, and there could be a very significant change of government there.
All right, Bloomberg's Maria Tadeo teeing us up perfectly. Thank you so much for your reporting from Paris. And as she said, joining us now for more on the European energy story and the upcoming Italian elections is Elena Bonetti, Italian Minister for Equal Opportunities and Family. Minister, thank you so much for being here. When we think about equality, there's obviously many different forms: gender, racial, income inequality also, and especially for the lower end of the income spectrum, lower income families grappling with sky-high inflation and energy prices. What should Italy be doing to help support those people?
Good morning, and thank you for this opportunity. Yes, Italy is now ready for a new investment of more than 10 billion to help families and companies to face this terrible crisis coming from the increase of the price of the energy. But we are strongly convinced that the main strategy has to be an European strategy. So we are promoting the fact that Europe has to fix a price cap for the market to buy the gas, the natural gas. At the same time, the main goal we have is to get rid of the Russian dependence. Italy is ready to be completely free starting from the next year, but we are also ready to face an emergency if Russian gas is decreasing before this period. We are diversifying the buyer to buy the supplier to buy natural gas, and at the same time we are increasing renewable source of gas and renewable source of energy for our country. But it is clear that national policies are not sufficient to face this crisis. It is really, really urgent that Europe plays a crucial and common role to face this strategic and crucial moment for our economy.
Okay. Minister, do you then, given what you've just said, does Italy still hope that a price cap can be agreed at the European level? Because it seems as if there is not cross-European agreement on that subject.
Yes, I know that it is a difficult point, but we are working to obtain this point. We think that it is important to reduce the impact of this crisis on the economy and on the production, not only for Italy, but for the whole Europe. We know that there are countries that are not agreeing with our position, but Mario Draghi was the first to propose this solution in Europe, and I hope also that the new government will continue on this position, because it is not only the interest of Italy, it is really the interest of Europe.
Okay, so for any Italian minister, clearly energy a real focus right now. But I know for you, Minister, equal opportunities and family are really where you are focused. Can I take us there then? Because there's been a big global conversation about falling birth rates. And I want to ask you about the Italian experience. Birth rates in Italy running sub-replacement rate right now, well below 2.1, at around 1.3. What can Italy do to bring up the birth rate?
But I think that Italy played a crucial role in the last year to promote gender equality, not only in our country, but also in the international agenda. Let me recall you that during our presidency of the G20 presidency of the Italian government, we promoted the first ministerial conference on women's empowerment, because it is clear, in particular after the experience of the pandemic crisis, that women play and can play more and more a crucial role also in the Building Back Better program for the economy, for the finance, for society, for rights, not only for women, but for all. It is really a question that we must release all the talents and the competencies that women can play in our societies. And to achieve this goal, we must continue to promote gender equality, to promote equal salary, to promote gender equality in career and the labor market, but we have also to change the rule. Let me, for instance, quote an innovative instrument we introduced in Italy for the first time. We introduced the gender equality certificate for companies. And companies that will obtain this certificate will have benefits from the point of view of the taxes, but also in the public procurement rules. So this is really a way to incentive the investment of the labor market and the business companies and the business society towards the achievement of gender equality.
Minister, thank you very much. We thank you for your time. Elena Bonessi, the Italian Minister for Equal Opportunities and Family. Coming up on the program, how to crisis-proof climate action. That conversation next. This is Bloomberg.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry cost $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
Here's the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
I will say that it's one of the happier moments of my climate work. I have two things that excite me about my climate work. One is when policy gets done well, and this is by far the biggest moment like that.
That was Microsoft co-founder Bill Gates. He is among the guests that will be featured in our new Bloomberg Green podcast, Zero, which is launching today. Joining us now is the host of that podcast, Akshat Rathi, Bloomberg Green senior reporter for climate. So Akshat, first, congrats on the launch of this podcast. I am super excited to listen to it. Just talk to us about what it's about and who you're going to be speaking with.
Yeah, thank you. Look, there's a ton happening in the world. I don't have to tell you. But we're going to have to deal with all that's happening while we have to tackle emissions. And that world of climate change and climate policy and how it collides with energy and politics and geopolitics, it's changing, and it's changing really rapidly. I've enjoyed listening to podcasts for a long time. I feel the conversational format is a way to understand a topic in a way that is detailed, that's gives you an understanding that is much more nuanced than just being able to read a news story here or there. And so on this podcast, we've got, as you heard, Bill Gates, but we've also got Chamath from Social Capital, who's getting into climate investing. We have the first climate minister of Canada, Catherine McKenna. We're going to have a novelist, an Indian novelist, Amitav Ghosh, who's written a lot about climate change and colonialism, and the list goes on. I'm really excited to share all this.
Chamath Palihapitiya?
Yes,
the
indeed.
Chamath?
The Chamath.
Will be interesting to hear what he has to say. You also spoke with Bryony Worthington, who is in the UK's House of Lords, about the crisis there, which is, I think, in terms of the Western developed world, the most acute that we're seeing right now. What did you take away from that?
It is stunning. I mean, the UK has been the country, the richest country to cut the most emissions in the world, 40% reductions since 1990. And now it's in a crisis with energy. It's got a new prime minister, a climate skeptic energy minister, and they want to obviously try and tackle this immediate crisis. So my question to Bryony Worthington, who was one of the authors of the Climate Change Act, was, will the government scrap the Climate Change Act or its climate goals in trying to deal with this short-term crisis?
Okay.
And she was an emphatic no.
Okay, don't tell us any more, or no one will listen to the podcast, Akshat, but this is a good trailer for it. Thank you very much for joining us. Akshat Rathi, Bloomberg Green, joining us to talk about the new podcast. You can catch new episodes of Bloomberg Green's Zero podcast every Thursday. That is it for Early Edition. More surveillance is ahead. They'll be hearing from Liz Ann Saunders of Charles Schwab, among others. This is Bloomberg.
what do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, you know, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view. And I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
No doubt the Fed's signaling that there is more work to be done.
They are keenly focused on price stability and reducing inflation, and that does mean, you know, sacrificing some real growth.
It's not really about whether we're going to get 75 or 100 in September.
To bring inflation back down to 2% over 2 years, we could be looking at 3 million additional people out of a job and also deep recession.
I think investors just have to hold on to their hats right now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
We have a deal. Live from London for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Equity futures positive, a little more than 1/10 of 1%. TK strikes on, strikes off. It looks like strikes off.
Widely predicted strikes off, maybe because of President Biden and his jargon. We'll go into the math later. I like what Greg Vallier says. This is a staggering deal. The velocity of wage increase has to be front and center for every other negotiating party.
That's what we need to discuss, Lisa. It's the return of bargaining power, employee power.
At a time when you have a shortage of workers based on the jobs that need to be done and the fact that really employees do have to step up, it also highlights the precarious nature of some of the supply chains, even now, at a time when people were warning of pretty dire circumstances should this strike go into effect.
We'll catch up with the team in Washington in about 10 minutes' time. We've also got to talk about this market. What happened to the bounce? Up another 1/10 of 1% today. We're all looking at the bond market, looking at stocks, and Tom, for me, we're 40 basis points higher on the 2-year off the highs of June, and yet this equity market is still 7-8% above the lows of June. Can you work that out for me? Real yields are higher, nominal yields are higher.
I can't go there other than maybe consumers better, and, you know, we're going to see a surprise here in earnings like we saw last quarter. I will say, John, there's some incredible bond math. Stay tuned for that this morning on radio and TV. There's some real tea leaves of breakthroughs to higher yields.
Stay tuned for the bond math.
I was about to say.
No, I'm serious. I don't want to do it now because George Rochester will stand up and walk out of the building, but there's some really cool bond math going on right now.
I am going to walk out of the building in about 59 minutes' time.
Is it because of the bond math?
What's to happen? It's for something else. Futures positive, 0.2 of 1% on the S&P 500. Yields higher as well by 3 or 4 basis points this morning. Good morning to you all. Yields drifting higher once again on a 10-year to 343.93. I believe the 2-year Bramo is higher for 6 straight sessions. Now, the 2-year still flying.
Yeah, 3.8162% right now at the moment. We've seen a complete repricing, and it's interesting to see that we actually are now pricing in a 4.4% peak Fed funds rate by the middle of next year. That is a reset. 8:30 a.m., we get a data dump in the United States. U.S. jobless claims, retail sales, Empire Manufacturing, among other data points. I'm really watching retail sales. How much do we get a boomerang effect? And this is what I'm watching because gas prices have come down, how much do people have extra money to spend on services and other aspects of the economy before the winter, sort of making it difficult for inflation to roll over? Because if gas prices rise up again, how much do you get a difficult scenario? I know this is kind of complicated, but it's something I was giving a lot of thought. Thanks. Today, Treasury Secretary Janet Yellen is delivering remarks from Maryland on tax code changes following the Inflation Reduction Act. We haven't been hearing that much from Janet Yellen, and I want to hear what she has to say about what we're seeing in the economy. She was in the transitory camp. She did a big mea culpa. Where are we now, especially as the Fed is poised with possibly raising 100 basis points?
Possibly.
I don't know.
We're going to catch up with Jordan 100 basis points Rochester in a moment.
Is that his middle name now?
Sure.
And today, China's President Xi Jinping meets with Russia's Vladimir Putin for the first time since the pandemic started. They're going to be meeting in Uzbekistan. I want to see, first of all, whether we get any relaxing on the zero COVID policies, B, what kind of commitment there is from China to Russia, and see whether there's any sense of some sort of capitulation on Vladimir Putin's side as a time when they're really not doing that well in this war.
Convention of the Dictators. We talked about that yesterday. Looking forward to what comes of that. That's what it is, isn't it?
It's Shanghai 5. It is Central Asia, and it is something that Mr. Putin would suggest is his territory from a previous time and place.
That might
There's
be.
a
lot of tension in this.
Might be the case as well.
America ignores this. It's actually a big deal.
We're clearly not ignoring it, are we?
No, I thought Lisa was okay.
We're promoting it for the second day.
Yeah.
Jordan Rochester joins us now. Jordan, 100 basis points, Rochester. G10 FX strategist at Nomura. Jordan, 100 basis points next week for you and the team. Let's start there. Why?
It's a big call. Well, look, the US inflation number was horrific. If you look at the details of it, everyone who was looking for peak inflation, you got it in the headline thanks to Joe Biden's oil SPR withdrawal. But the actual details, so we're seeing firms are raising prices much more than what we'd expect for core CPI. So with the rollover in gasoline prices and input prices, all the surveys we follow say down, inflation has peaked, but core inflation keeps rising, keeps surprising. And I think the savings that everyone has built up still from 2020 and last year, I think that's still playing through. So it was a strong number. We've got about 82 basis points priced. Usually the Fed doesn't do anything unless it's priced in. So I am concerned if it's not priced in a bit more, they won't do 100 basis points. But look, we've got this Friday. Is there a leak to the Wall Street Journal as to what the Fed will do that will move the market price? And we tend to see that a week before.
I'm the only one that doesn't get this.
As soon as the number came out, I turned to Lisa and I said, well, you know, do you think maybe we get one of those newspaper articles again?
From Nick Timmeros? That's what you're talking
Something
about.
like
Yeah,
that.
but carry on. I mean, let's just call us, you know.
Am I the last to know about this?
That's what happened last time when we shifted to 75. You don't remember that, Tom?
No, I don't. The Greg's sausage roll you brought by today was great. You can come anytime. Jordan, I want to talk about pound 115.17 after the Fed meeting. I believe the Bank of England will meet. How have you adjusted your sterling vector in the momentum of it, given what he has to do because of what Chairman Powell has to do, but with the debris of the British economy?
Indeed, the risk is the Bank of England's more forceful next week. We're kind of looking for 50 basis points from them, but they could do 75.
What does that do to sterling?
I think short term, whenever a central bank does more than expected, you'll have probably for 20 minutes sterling strength. Let's say they do 75. Let's say they do 100 basis points. But the UK is not suffering from the same problems that America's facing, suffering from bigger problems with energy in terms of the terms of trade shock the pound's facing. So the trade balance is getting wider.
Right now.
So I think sterling goes to 110 by the end of October, and we could be talking a horrible 106 by year end.
So we come back first week of November?
No, we come back for parity.
You're looking for the place in, is it
I'm
Knightsbridge?
returning when we get to parity.
Parity.
That's my call. But Jordan is raising a really important point here, Lisa, and we've been discussing it. These massive plans from this government, how are they going to execute them? Do they need higher yields? Do they need a weaker currency? As Tom pointed out, we're back to 115.
Yeah, and that seems to be what a lot of people are saying, and yet some of the recent inflation data out of the United Kingdom has been somewhat supportive because some of these planes have lowered petrol prices, have lowered natural gas prices and their energy bills. So this is sort of the boomerang effect that I'm worried about, that I've been looking at, is that if you lower these prices, it actually encourages people to spend, creating a stickier type of inflation. Do you think that really the tipping point here is higher yields and basically a Bank of England that has to come out even more aggressively from their incredibly honest stance of just a few months ago.
Well, the Bank of England, they're one of my favorite central banks for their transparency.
Right.
So they have forecasts with recession, GDP negative 4 or 5 quarters in a row, and inflation being below their target at the end of the forecast horizon. Many other central banks are not forecasting recession. So the Bank of England has already got a tough job. They're raising rates into this recession. They're being very honest about that. For the second round effects, you're absolutely right. Our energy bills in the UK at one point would have been £6,000 a year on average in January. Now it's going to be around £2,500. That's fantastic. It means you can keep the lights on, keep the heating on, put the hot tub on the sauna, whatever you want to do with your electricity, you go do it. The prices won't be as high.
The hot tub.
But that's a big problem for the trade balance.
Like
Consumers won't reduce their energy usage, and industry.
Keep talking, please. Let them
Indeed.
go.
So the trade balance will turn even more negative. The UK, it's a bit of a cliche to say, but the UK is trading like an emerging market. You have 8% current account deficit. That's crisis territory in Q1. I think it's going to be around 8% over the next 2 quarters. The Bank of England raising rates, it's helpful. It's softening that blow. It will attract foreign gilt investors. But let's look at equities and FDI. It's not the same story.
Just quickly, you also have a pretty bold call on the euro. This 90 figure that has gotten a lot of attention at a time when we're seeing just kind of still hanging in there around parity. What gets us to a 90 level on the euro, 0.90?
Indeed, clients were asking me just last week, look, we've had a big move in the euro, but what's the catalyst? What's going to get us to 90? We've got a few things coming up, but the big picture is euro, its terms of trade has collapsed, just like the UK's. The US has things that Europe needs, natural gas, LNG. So I think when Germany starts to ration energy, it will become clearer to everyone that, oh my God, the trade balance of the German economy is going negative. Paper, plastics, acrylics, metal, all of that won't be made if factories are turned off. Where are you going to buy that from? You're going to buy it from America, where the cost of electricity is 6 to 7 times less, and China. So that trade story is what gets us there in the medium term. Triggers for it are if you see the phase 3 coming from Germany, or if you see Russia turn off gas supplies even more, those sort of triggers will do it. But the other part is the Fed. So next week, if the Fed does do 100 basis points, it will change people's dynamic for Fed pricing, and that will boost the dollar in the short term.
Jordan, this reminds me of when Italy shut down that weekend, back in the pandemic in 2020. That it wasn't real for many people until that moment when we saw it happen in Italy. Is that what we're waiting for again? Then you just said it. Are we waiting for that moment, even though it's so clear to all of us that Europe's about to go through a really, really difficult time? Do we need someone to scream it at us later this winter?
I kind of think we are raising the alarm bells. I hope we are. It's been written about quite a lot in the media, at least. Well, look, I think what will happen is Germany will get through the winter. People will be able to heat their homes because factories have reduced their output. The demand for gas will be down. That is recessionary. It sounds nice because you keep the heating on, but it's recessionary. You are not producing those goods. The German economic model is being challenged. All these sort of base metals, these sort of high energy goods are cheap, but you need a lot of them to run your economy. They're going to come from abroad.
Nomura Hong Kong just emailed me and they said, have them give a renminbi call. Today, 2 standard deviations, we are through 7 yuan per dollar. Is that an important level for the government, or are they waiting for 8 yuan per dollar?
Well, look, we're looking for 720, which is the sort of recent high in recent years. I think that's going to be achievable by year end. The Chinese have looked to slow down the move of the currency. We've seen moves from the central bank. We've seen comments about the weakness. So we're seeing quite clearly renminbi on a basket basis is being very stable. So against its peers, euro, yen, Korea, very stable. But against the dollar, yes, it allows for some strength to come.
So should we look at the basket?
No, I think the trade is in dollar CNH rather than the basket.
Can we squeeze this in? Just a quick yes or no. Yield curve control, the BOJ, is it gone before year end?
No.
Okay.
But next year, maybe. Who knows?
All right. Jordan Rochester.
That question will get you
Jordan,
in trouble.
thank you. We give us a no.
Okay.
Do you want more detail?
No, I don't.
Good, we've got to go. Coming up.
Save his career.
In the next hour, Jeff
The Rex was great.
Senior market strategist of Bank of New York Mellon. You're done, you're leaving. After the first block.
No, that's I'm going to stick around for a little bit longer.
4 more hours. Futures up, 10th of 1%. People are so excited about that.
3 hours and 50 minutes.
There we go. You're counting down, aren't you?
Oh, that's Tom.
Live from London. This is Bloomberg.
Keeping Keeping up to date with the news from around the world with the first word, I'm Angel Feliciano. There's a tentative deal to avert what could have been a damaging railroad strike in the U.S. The Labor Department says that railroad companies and unions representing more than 100,000 workers came to an agreement after 20 straight hours of negotiations. The government says the deal, quote, balances the needs of workers, businesses, and the nation's economy. The price of natural gas rose again in Europe today. Traders are weighing whether the EU's steps to contain the energy crisis will be enough to curb prices. The plan includes a mandatory limit on peak power demand and raising $139 billion for consumers from energy companies and earnings. The leaders of Russia and China meet today in Uzbekistan for the first time since the invasion of Ukraine. Shortly before the attack in February, Vladimir Putin and Xi Jinping declared a no-limits friendship. Still, after suffering humiliating losses on the battlefield, Putin shouldn't expect much help from Xi. China has resisted sending military supplies or financial support. The CEO of Shell will step down at the end of the year. Ben Van Beurden has been at the energy giant for almost 40 years and has been chief executive since 2014. One of his first big moves was the $50 billion takeover of rival VG Group. That's now paying huge dividends as natural gas prices soar. Van Beurden will be replaced by Shell's head of gas and renewables, Wael Sawan. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
In a $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg. All eyes are on the Fed.
The Fed has more work to do.
75 basis points seems to be baked in.
How quickly do they get to the terminal rate?
How long do they hold them there?
Chairman Powell's going to have to read the same speech twice.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Is the consumer buoyant?
The dollar is a great place to hide.
The U.S. are going to overdo it. Investors just have to hold on to their hats.
With special commentary from former Fed Vice Chair Richard Clarida. Bloomberg Surveillance. The Fed Decides. Wednesday on Bloomberg, your global business authority.
Concerned about the inflationary policies that we see coming out of the Biden administration. Anybody who thought that this was going to be short-lived has been shaken, because what we're seeing is the persistent result of bad policies, inflationary policies.
Governor Youngkin there, the Republican from Virginia, live from London. This is Bloomberg, and here's the price action for you. Equity futures up a little more than 0.1% on the S&P 500. Yields higher once again by 3 or 4 basis points on a 10-year to 344.12 on a 10-year. On a 2-year, we've been climbing now for 6 straight sessions and getting used to, comfortable with life in and around 380. Just unreal stuff. 2 things to say. One, are we all looking forward to the former Vice Chair Rich Clarida on Fed Day, or what?
Yeah.
Going into the news conference and coming out of the news conference as well, Lisa, next Wednesday.
It's going to be really interesting to hear how the deliberations are taking place and how to interpret. Perhaps those will be our tea leaves to understand what the communications are, although I think it's been pretty clear.
It's going to be very cool to get him to break down what his former boss thinks about the economy right now. So that's one. I promised 2. Ray Dalio of Bridgewater with, I'm going to say, a pretty punchy call, TK. Looking for the prospect of rates going to 4.5%, producing a 20% negative impact on equity prices.
Those are calculations that people make every day. And it depends on which indices you're looking at. You know, we make jokes about the Dow and the S&P and the NASDAQ, but the truth is each index is different to get you to that 20% statistic. And I'm sure Mr. Dalio can expand on that.
But before we get to the consequence of higher rates, let's talk about the prospect of higher rates. 4.5% after the print we had this week doesn't feel that out there at the moment, does it?
It feels priced in. That's the amazing thing, priced into the Fed funds rate. And what Ray Dalio was saying, that it was 20% negative impact from here, from where they are. That was what he was saying. And he said about 10% of that was because of the negative earnings impact. Basically, how much the economy would have to slow. This goes to the Mike Wilson point. This goes to many other people who are raising this issue. How do you game that out? And I think that that's going to be really the theme of so many discussions.
Thank goodness Lisa actually reads this stuff, Tom.
Yeah, one of us does as well.
In the commercial break next to me.
Let us continue here on the romance of American railroads. I lived the back end of it. It was the Pennsylvania Railroad, and the Pennsylvania Railroad dumped into New York City at the Greenville Rail Yard in New Jersey. Hugely historic back to 1904. History's out the window today. Jack Fitzpatrick in Washington, but first at Greenville, Kriti Gupta joins us this morning. Kriti, what were these 2 sides arguing about?
Tom, you know, everyone right now is looking for higher wages, but for the railroad workers, it's a different story. It's about sick leave. It's about access to just easier working conditions. I mean, look, goes back to the rhyme, right? You have working on the railroad all live long day. This is a very intensive industry, 12-hour days that require you to be on call and then show up to work with about 90 minutes notice. So that's really what was at the core of some of these worker issues, in addition to, of course, pay, which it looks like they got. But one of the still questions is, how do you deal with things like sick days, like health coverage, even anticipated leave? Those are all things that are up in the air.
Yeah, brilliantly said, folks. And in the articles I've read in the last 20 minutes, we really don't know what the social aspects are of this agreement. Jeff Fitzpatrick, there are the political aspects of this agreement. Did President Biden win this morning with his tentative agreement?
Yeah, if the tentative agreement turns into an agreement period, then that's a big win. The risk of putting him in an uncomfortable position with unions, the risk of economic damage from the strike less than 2 months before the midterms would have been very, very significant. The rail officials had said it could be $2 billion in economic damage per day if there were a strike. An extended one would have been really bad. Assuming this does go forward and it's more than just a tentative agreement, it's a really it's a bullet dodged by the president politically.
Grady, some of the details, you've given us some information about a 24% wage increase through the 5 years, 2020 to 2024, as well as an immediate payout of about $11,000. Do we have a sense of how close we are and whether this will actually be enough to avert any ceasing of activity in the short run, since I believe the agreement's already up?
Well, Lisa, that's the fear here. And if you actually look at the fine print of what we are still waiting on the full details, but some of the fine print here is that $11,000 immediate payout. That's what seems to be new in this agreement. The back pay was already discussed. The 24% increase into 2024 was already discussed. But remember, going back to my earlier point, the sick leave, the kind of extra safety around working conditions, that's really what's at the heart of the matter. And remember, Lisa, some of the damage is already done. You already have, say, Amtrak canceling a lot of their long-distance train routes. You have oil shipments that are halted. You have feed shipments that are halted, grain shipments. Even as we were coming here to Greenville Yard, there are actually trailers of new vehicles that are just put on the sidelines because they have nowhere to go right now, Lisa, because everything is being put on pause for fear that this strike will actually go through.
Hey, Critty. Great work, thank you. Critty, up to that. And Jack Fitzpatrick on the latest in the United States. So, Tom, I've got to say, Secretary Walsh absent from the conversation there, but you'd have to imagine that the Labour Secretary, former union guy going back to his early 20s, had a big role to play here in the conversation.
And an authentic voice to both sides. He's someone that has a huge integrity. This coming from Dorchester and South Boston and the union battles of Boston. But, John, in another time and place, and as Greg Villiers lays out this morning, the math of this is a stunning lift in wages, but also is it a sea change to a new labor power, as Lisa mentioned earlier?
Yeah, I'd go a couple of steps further, Tom. It's a big moment for union power right now because more broadly, labour bargaining power over the last 2 years has been phenomenal. And for a president in the White House who keeps referring to himself as a union guy, this is a moment where unions, both for rail, we just discussed that, and in the LA ports, are in a position where if they wanted to, they could hold the economy hostage in a big, big way. And the fact it's not going in that direction yet, and I hope it doesn't, as Jack Fitzpatrick said, that's a bullet dodged for this White House.
Just to give you some scope on what kind of bullet that would be, it's about $2 billion of cost every day. It's about, however many tons of corn, of some of the fertilizer that's used for all of these crops. It would stymie so many different industries. And so, yes, it's a bullet dodge, but it's the reason why there is this presidential emergency power to come in and provide some sort of emergency response. President Biden doesn't want to do that because he is pro-labor. So he doesn't want to be seen as doing that, which is the reason why this is so incredibly awkward on so many levels.
It could have been a whole lot more tense than I think it's actually become, and let's hope maybe this is the deal and it doesn't fall apart.
What happens in the United Kingdom?
Well, the rail strikes, Tom, called off for the Queen's death.
Yes.
So this stuff is going to bubble to the surface again in the next couple of weeks.
But the heritage here is a little bit different than America.
It's changed. Union participation, just like in America, Tom, has changed so much over the last few decades. It's certainly not the 70s now, is it?
No,
it's not the 70s now.
Back in the 70s, there was fire and rain.
A union participation was very different. Liz Ann Summers has got something to say about, is it fire and rain or rain and fire?
She was listening to Stevie Winwood and...
Yeah, we didn't even listen to it yesterday.
Nope, didn't even bother. Live from London. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else. It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East.
Right,
with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Live from London, this is Bloomberg, and here's the price action. Equity futures positive by 1/10% on the S&P 500. If you were looking for a rip-roaring bounce, you didn't get one from the losses just a couple of days ago. Yields are still climbing by 4 basis points on a 10-year 344 and a 2-year through 380 in the last 24 hours. Mike Ferroli over at JP Morgan has some things to say. Chief economist is pushing back against this 100 basis point talk. He says we think the odds of a 100 basis point move, though certainly not zero, are lower than a third. Good drivers don't increase their speed as they get closer to their destination. That last line, I put this out on Twitter just yesterday and got a ton of pushback on that last line. Are we getting closer to the destination? Or have we just found out we're a bit further away?
Well, and also some people might disagree because I know a lot of good drivers who might go a little faster as they get close to their destination to get home because they're excited. But that is the question, right? Are we getting close enough to the destination? And if you don't go hard enough, if you don't go faster, do you get further away? And this is what a lot of people are raising, including Larry Summers.
That is so well framed, Lisa. That's brilliant.
She did okay.
Thank you.
That is brilliant.
That's good.
Really? Are you being sarcastic?
Part-time Morgan Stanley. Just, you know, the opposing view.
The key word there is speed, which is a first derivative approximation. And what Ferroli's talking about is, do we want central banks gaming the second derivative, the accelerative forces up and down? There is no history they're able to do that. None.
Raise and hold, Tom. Raise to maybe 4, hold for the whole of next year.
Measured.
Things are changing.
Measured for years in the equity markets is Lizanne Saunders, Chief Investment Strategist at Charles Schwab. She has been of huge value to us. She joins us today. Lizanne, I'm going to rip up the script and go to something that Mr. Farrow said earlier, which is the linkage of the bond market to your equity space. How linked are bond dynamics right now to what we see day to day in the equity market?
Only marginally so. I think the bond market, maybe especially in this kind of environment, but I think you could say this generally, tends to have, I don't know, maybe a more rational, not irrational, message about what's going on in the economy with inflation. I think the equity market can sometimes be a bit more irrational, and the two have not been sending the same message, and I think the bond market is sending the more appropriate message. You didn't see the kind of weakness in the equity market that you would have expected when we recently saw spreads really pick back up. But I think the volatility associated with that would probably be greater with any upcoming blowout in spreads if we get that.
Watch what they do, not what they say. What is retail doing now, and for that matter, institutional doing on equity flows?
Well, in the past month or so, and this is broad flows, not just within equities, but across all asset classes. So this is not just specific to Schwab. a big renewed interest in bond funds. In fact, over the past month, you've seen close to 45% of all inflows have been into not just broad bond funds, but government bond funds specifically. And I think that's because you've got obviously nominal yields up, but real yields as well. So I think there's a bit of that caution, but also taking advantage of the fact that there's income in fixed income now.
Lisa, that's really working out, isn't it?
Well, I mean, it is if you start now, right? But if you started 6 months ago, maybe it would have been a different story. Lizanne, we were talking earlier about the Ray Dalio call of a 20% decline in broad stock indexes. And he talked about how that's an average, and you go under the hood and they're more or less, with the acceptance of a 4.5% Fed funds rate. Now, that's almost what's being priced into the Fed funds rate market. Do you agree with his assessment of how much more the equity market has to fall to be in coherence with that?
So, I mean, the short and honest answer is I don't know. I don't know whether we've got another 20% downside. I'm not sure. The fact that I don't know matters all that much. Would it shock me? No. I think we have had a bit of a retreat in valuations, certainly a retreat in valuations relative to where we started 2021, but of course valuations had been artificially boosted by virtue of the pandemic-related plunge in earnings. We got the recovery in earnings that brought valuations down to actually pretty reasonable levels at the lows in June, and then they popped back up again. Of course, inflation is a variable. Now we've got the rolling over in earnings estimates, which is putting upward pressure, all else equal, on valuations. You've got high inflation in a zone right now that historically is only supported on average a multiple in the 11 to 12 range. I'm not suggesting we have to go all the way down there because inflation is on the move and the market can discount the, to Tom's point, sort of second derivative rate of change. But the sweet spot of 0 to 2% in inflation for valuations where you've traded on average at an 18 multiple or so, to John's point about destination, there's a long way to go before even just the math allows inflation numbers to have a two-handle on them. So the valuation story still suggests that there's more downside unless the retreat in inflation happens much more quickly.
More downside that could potentially be more dramatic than perhaps some people are factoring in. Lizanne, how close are you to the Oksana Aronov of JP Morgan view, where she's holding some 70% of her portfolio in ultra-liquid assets, preparing for a better entry point?
Well, it depends on who you are as an investor. That might be an appropriate strategy to have, either if you're trading oriented or trying to catch the shorter-term moves in the market. But if you are a long-term investor that has a fairly high risk tolerance, you don't need the money, you're not living on the income associated with what's generated from your portfolio, then I'd say you can take a more risk-tolerant stance. If you are a retiree and you've got a nest egg and you're living on the income associated with that and you can't afford to lose any of the principal, yeah, you want to take a much more defensive stance. It really depends on who the investor is, not what mine or anybody else's opinion of what the market is going to do.
Lizanne, on dollar strength, we just hit 7.00 yuan per dollar. You go back to September of 2019, maybe a level of 7.18, something around there. That brings us to this quarter's earnings. Are we at a point where FX recalculation for American multinationals is a tangible distraction?
So the fact that the dollar has been so strong, the math suggests that we should have seen a bigger hit to earnings, but there were positive offsets. I think multiple hits are likely to come more to fruition once we get to third quarter reporting season, the dollar being one of them. The fact that we've got the demand profile that is weakened at the same time that you've got labor costs now as a share of revenues, it suggests profit margins 2 full percentage points lower than where they are right now. And I think just the beginning of this re-rating of earnings estimates. So we all thought we'd see it a little bit more in the second quarter, although ex-energy earnings were negative 2%. I think we're going to see it more in earnest in the third quarter.
I've aged waiting for small cap to pop, and the basic idea is small cap, mid cap is a domestic feel away from FX dynamics. Do you buy the theory?
I do, except that you've got a lot of lower quality companies in some of the bigger small cap indexes, not least being Russell 2000. And that's where some of the zombie companies have been housed and living for a while. So that's the rub. Yes, you get that more domestic bias in general to them, but you also have a bit of a lower quality profile. Valuations, because of the underperformance, have come in, and the valuation spread it alone is supportive of small caps, but I think we have to weed out some of those really low quality companies before I think there can be a call that small caps are ready to have a period of sustainable outperformance.
Lizanne, before we let you get on with your morning, I have to just give you a victory lap. Your charts that you put out on Twitter are always fabulous, and you really pinpoint many of the main issues. And I wonder if there is another pivot point data entry that we could be watching for. For example, the CPI print was a pivot point for the market, and I don't mean it in the Fed's way. What's the next one? What's the next most important data point?
Well, it may not be a data point. I think it may be what Powell has to say in the press conference. You know, the big debate that erupted after the CPI report was it going to be 75? Is it going to be 100? We're still leaning towards 75 just because I'm not sure Powell wants to do shock and awe a week in advance of the meeting. I think it's more to John's point earlier about, you know, what's the destination? How long is it going to take to get there? But importantly, once we get to the destination, are we going to go in and stay for a while? I think the pivot idea, to go back to the Fed's meeting and what the market was pricing in June, was that when we got to the destination, we'd say hi and then we'd turn around and go the other way to rate cuts. I think the Fed is trying to just put that completely to bed. But anything that gives us a better sense of the level of aggressiveness that's likely to continue through at least the end of this year, and firming up this notion that once we get there, we're going to stay there for a while. I think that's the next important message coming for the market.
Lizanne, just about speaking terms with me at the moment, Lisa, because I hadn't heard of the song Wind and Rain before. Just never heard of it.
You mean Fire and Rain?
Fire and Rain.
That's you're nailing it.
Lizanne song, Charles Schwab.
Was that
I'll
intentional?
pull out Spotify later and listen to it.
Okay, good. I'm glad.
Painful, Lizanne. I'm sorry.
Lizanne gets to go. You have to stay with me.
Yes.
Lizanne, thank you.
John, on why we are in London, and it is a day of reflection, you actually walked what King Charles walked yesterday. He is taking finally a day of rest after the agony of the last number of days in his leadership of the nation. What can you imagine in that step that they were doing? That's a tough walk yesterday, isn't it?
Well, Tom, for anyone who's lost a parent, can you imagine playing that out so publicly?
Yeah.
And walking behind the coffin in that way?
Yeah.
In front of crowds of people in the way he has done. And at the same time, you need to fulfill a whole host of obligations where you have to go through to the four nations that make up this union.
You two did this. I talk about it. You guys actually did the walk over the weekend.
John, the way that you put it to me yesterday, not on air, about how it's an entire nation empathizing with the understanding of losing a parent. And then you put the pageantry on top of it, and you feel the power of that. And I think that was very well framed.
And the loss is deeply, deeply emotional, whether you support this monarchy or not. The Queen lying in state for the next several days through to Monday morning before the funeral service here in London. From London, this is Bloomberg.
Keeping you up to date with the news from around the world. With the first word, I'm Angel Feliciano. A marathon bargaining session has led to a tentative agreement to avert a railroad strike in the U.S. The Labor Department says that after 20 hours of talks, railroad companies and unions representing more than 100,000 workers reached a deal. A strike would have frozen critical infrastructure that transports about 40% of all long-haul cargo in the U.S. Ukraine is solidifying control over territory its troops have retaken from the Russians. That's according to President Vladimir Zelensky. He meets with troops in Izium, the biggest city recaptured last week. Ukraine's general staff says Russia is again targeting civilian infrastructure. Top executives from about 20 leading global firms have committed to flying in for Hong Kong's financial summit in November. Bloomberg's learned that CEOs at Morgan Stanley and Citigroup are prepared to come. Attendance by many of Wall Street's chiefs is still contingent on Hong Kong ending its 3-day quarantine for incoming travelers. In China, economic growth has slowed so sharply that several major banks don't even think a 3% increase is achievable. Projections have come down steadily since March, and the consensus in a Bloomberg survey is for the Chinese economy to expand 3.5% this year, the second weakest in more than 4 decades. The official data for August comes out Friday. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
Diversified our gas supplies. We have secured sufficient levels of underground